Hey, you know what? What I say I used to tell the kids when they were little kids, when I used to coach little kids, if you're early, you're on time. You're on time, you're late. If you're late, don't come. Yeah, I mean, so anyway, I'm glad you're here. There's some people that aren't here, but that's, you know, their issue. So anyway, welcome. So this is week 2. We got 6 more. Well, so do we want to be optimistic? Do we want to say we have 6 weeks to go, or do we have 5 weeks to go? 5, right? We haven't really done today, but we got 5 weeks to go. Okay, so anyway, let's just assume that we're done. So we got a lot of material to cover again today. We got a lot of material to cover every class. So we'll try to make the most, the most that we can out of it. We'll have I'm not really going to spend a lot of time. We'll just do a little bit brief overview of what we did last week, and then we're going to roll right into some accounting concepts. So the next 2 classes, we're going to kind of do some basic accounting and financial reporting concepts, and then next week we'll go into some more in-depth detail, and then some analysis. Because as I said before, here's what I was thinking, right? You're an architect, right? Who's not an architect here? I'm not an architect, right? But you're in a development program, right? You got to figure out how to read architectural plans, right? You need to understand what elevations are. We need to understand scale. Now, we don't have to be an architect. We don't have to have the gift, but we need to understand how to read their drawings and their plans. It's the same thing with financial statements, right? And I don't want to jump ahead. We'll go over the case study that some of you submitted. We really do need to bulk up or beef up some of our financial skills or understanding, okay? Because at the end of the day, it's very difficult for us to understand, read the tea leaves, understand what's going on in the world if we don't understand the reports are in front of us. So we'll do a little bit of that today, and we'll spend a little bit more time, and we'll sort of like evolve as the course goes on in that. Okay, so spend a little bit more time on that. We'll talk about some of the specific nuances that real estate companies have and how or why their statements are a little bit different than regular companies. Okay, so that we can distinguish that, and then we'll prepare for the case study for next week. So kind of sort of rolling forward from that. So. So last week, I want to make sure that we, so a couple other things. If time permits and you have an interest, we can handicap the Preakness for later today. If you guys are interested, now we can stick after class and you guys are interested. One of my pastimes, look at the companies, you see if maybe you make some money. Can't make money at work, gotta make money, having fun. So anyway, if you're interested, if you're not interested, then we won't look at it. It doesn't really matter. I got to do it at some point anyway. I sent last week these, abbreviations and concepts, and we went over some of them. We didn't have time to go through all of them, but it's important that we understand all these concepts. Things like, I'll throw around things like FFO. Not this week's case study, but next week's case study, we'll talk about FFO, funds from operations. Very, very, very widely used term in the media, in the press, related to real estate investment trusts, right? That was another one, our REIT. We'll talk a little bit about what a REIT is today, and we'll get into it in further detail so that we understand it's a tax advantageous structure that's used in real estate. But FFO is a proxy for net income in REITs, okay? And it's really a measure of cash flow, and it sort of tries to emulate in a public company reporting structure what NOI is. So it's basically net income, and you add back depreciation, and you add back gains and losses on sales of assets, okay? So, hold on, so I don't want to keep you guys late, because you did come relatively on time. Jeffrey, you came, right?
Yes.
Where are you? There you are. Because whoever's not here now, it's kind of like, what was I was thinking? I was driving in like, what do you think, this is church or something? You can get here late? God's like, forgive me, but I'm not. And God doesn't grade you. Well, maybe grade you, but Chanel, you came in, right? Okay. And Kyle, sorry?
God does grade you.
He does grade, yeah, but we won't find out till it's too late, right? Kyle, you came in, right?
Yes.
And you are?
Anthony.
Gotcha. All right. and Michael, yeah, you kind of can't.
Within 5 minutes.
That doesn't count. That doesn't count. So you don't come in at 8, you lose at least a point, and then you go on from there. Sorry. You come. Sorry. And so then, does anybody know who Kanisha is? No. Do we know who a Brandon is? Williams? All right. Okay. Whatever. It doesn't matter. Okay. So anyway, I'm sorry. I apologize for that. Okay. We talked about real estate. What's real estate in this class? What's real estate? What is real estate in a financial reporting or accounting class? What is real estate? Real estate is. So it's a beautiful thing we build. It's our legacy. Is that what real estate is?
An asset?
It's land plus the improvements there.
Yeah, land, buildings, and improvement thereon. Okay, land, building, and improvements thereon. Right. So I like to contrast that. Right. When I used to teach capital markets class, how did I define real estate? I define real estate as a financial asset, and we know that a financial asset is worth what? Yeah, well, I'll say it a different way. Nothing more, nothing less than the net present value of future cash flows. So in a capital markets class, I defined real estate as cash flow, as something that generated cash flow. Right now, if you were to take a class with a developer, what he might say real estate is, right? It's my legacy. You know, it's art, it's architecture. It's a very well-known developer in Miami. I won't mention his name. Very well known. You know, sometimes very successful. But at some point in 2008, he gave back a development project on Brickell Avenue, and at the time he owed Bank of America upwards of $600 million. And I remember reading an article in the Wall Street Journal where he said, "It doesn't matter if I don't own it anymore, I still created it." I don't know, I kind of look at it as a failure, but you know, in his mind, he still drives by, and it was, and so real estate is a lot of different things to a lot of different people in different times. But here, it's assets, right? It's land and what's on it, okay? And then leasing, we'll talk a little bit about leasing later today, and we'll expand on it a little bit more tomorrow. Leasing is a widely utilized financing technique in real estate. What is a lease? What is a lease?
The right to use.
Well, you say short-term rental. I mean,
The right to use.
it's a right to use, in this class, real estate, so it's a right to use real estate for a specific period of time. Okay, and so a lease as a contract needs to have a finite period of time. Okay, we got that? But listen, there's a whole bunch of other stuff. I'm not going to go repeat them. I encourage you to go back, look at them, figure them out, understand them. Okay? We had a bunch of questions from last week. We had a couple questions from, like, the people sent me questions. So Oz sent me some questions. She asked me a question last week, and she wasn't quite sure what she was asking, but she then found the link and sent it to me. So, because I like to clarify things. So she asked a question about tax deferrals and REITs, and the answer that I came up with at the time, I think partially addressed her response. So the way what happens is there's we don't need to get into this. There are two kind of REIT structures. There's a down REIT and an up REIT. Okay, and it doesn't matter which one's which or how it works, but one way in which a REIT can acquire an asset, right, is to create an up REIT structure in which it acquires, right, so it's an SPV, right, it's a special purpose vehicle or a special purpose entity that acquires an asset from a third party, right? So the asset comes into the SPV, and in exchange for that, this down REIT sells units or shares, exchanges shares for that asset. This is a tax-free exchange to the selling shareholder until he monetizes those units or those shares. Okay? So once these units are sold, then that becomes a taxable transaction to the person. Until then, it's not. Okay? Got it? So that point was right. Now, the structure, the concept that Oz sent me in an article was a little bit more complicated than that. And so what it said was that a person wanted to sell an asset, but the REIT didn't really want to buy it because of what it didn't fit into their portfolio. But the guy was still looking to do some sort of tax-free exchange. So what that person would do would be to sell their asset to a third party and do a 1031 exchange. And they would acquire an asset that would be interesting to the REIT. And so then what that person would do would be hold the asset for a while and then do the same type structure with the individual. That seems very convoluted, and it threw a bunch of tax code sections around. So this is a Section 721 exchange, okay? And this is a Section 1031 exchange. So basically, you wind up with a 721. But what you were, proposing, or what these people were trying to sell was do a 1031 into an asset that you perceive would actually have interest to the REIT, and then you hold it, right? You get the tax deferral here, and then you get the tax deferral here again. Okay. You asked another question. So Oz asked me another question during the week, and I thought it was important to talk about this one because I used to cover capital structures in the capital markets class, but I don't really here, and it's important. She asked me a question about preferred stock and what preferred stock was. So, what preferred stock is, we don't know. Okay.
Is it where you get paid first?
preferred.
Well, I mean, there is a
Yes,
preference.
preferred,
You
yes,
get
common
paid
stock.
first. Who's you and who pays you?
Whoever owns the preferred
There's
stock.
preferred, there's common.
It's preferred to common. What's common?
Common is
It's subordinate to preferred.
yes.
We just have a circular argument here,
Preferred is
right?
antecedent to
So,
common. So
Let's go back to the San Miguel balance sheet. Assets are supported by capital, right? Assets equal liabilities plus equity, right? And so last week what I said is that we had liabilities and equity. Liabilities or debt. Debt, and let's talk about secured debt in this context. Secured debt is what? Debt that has a
back, a
it has a direct link or direct security to an asset. A mortgage. We talked about mortgages last week. So a mortgage is a security interest on real estate, right?
Yes.
So let's just assume that the debt or the liability that exists is a mortgage. So it has a direct right, lien right, or direct correlation or security to an asset. What is equity by definition?
equity is
So let's look at it a different way. Let's change the algebraic equation. Assets less liabilities equals equity, right? So by definition here, equity is the residual interests that exist in the assets after liabilities are satisfied. Okay? So we could say, well, equity is our... Dude, you can't bring food in here unless you share.
I'm sorry.
I'm just kidding. I'm just kidding. I mean, I'm starving. No, okay. Good. No, hey, listen, you guys want it. I'm okay with you guys eating. Okay, don't worry about it. As long as you share. No.
I'll pass it around.
So, listen. So equity. So all equity are shares. Equity is what you put into. It's all that stuff. But really, equity is the residual interest in assets after liabilities are satisfied. Okay, so we're not going to get into, that was another thing I used to cover was bankruptcy, which we hopefully don't want to know a lot about intimately, okay? We don't want to know about bankruptcy, but in bankruptcy, what is bankruptcy?
it's your liability.
Well, when you're screwed.
Your liability way much more than your asset.
Well, you don't have to say way more. Okay, so technically,
Liability is more than your assets.
okay, so when you've got a situation, right, where liabilities are greater than assets, right, that means you've got negative equity, right? Now, can you be bankrupt and not be insolvent. What's insolvent?
Insolvent. When you cannot
What's
satisfy-
Insolvency?
When you don't have enough assets to pay for your liabilities.
Well, I mean, that's bankruptcy, right?
You're incapable of making.
So insolvency, you're not, so it's like, kind of like thinking an accident, right? You get in an accident, you lose all your blood, you die. Doesn't matter if you get blood later, you're dead, right? A company, the blood of a company is cash. If you don't have enough cash, liquidity to satisfy your creditors, right? Then you may not be, so you may not be bankrupt, but you could be insolvent. You could be technically, right, solvent, but practically insolvent, right? So you may not be bankrupt and you could be insolvent. By the same token, you could also be bankrupt and not insolvent. That can happen with a bank, because a bank has a lot of liquidity. They may have more liabilities, and that's what happens in, 2008. There were a lot of banks that were technically insolvent. Right now, regulators may have looked the other way. They may not have, properly classified their loans, but they had enough liquidity to stay in business. Okay, so I don't want to go back. So when we take a look at this thing, is when we do so. When we are bankrupt, we've got an ability to go to the courts, or when we are insolvent, we can go to the courts and seek either a reorganization or an orderly wind down of the company. Those are the two kind of options. Chapter 11, you try to restructure your debts or your capital stack. Chapter 7, you basically say, look, there's no value in this business, let's liquidate it. Okay? We're not going to cover that in the class, but at least they're concepts that if you have an interest, then you look at them during the week. Okay? So, but in a bankruptcy, then there is a hierarchy of distribution of the assets. So if you do a Chapter 7, you're going to liquidate a company, you sell all the assets, then logically, you're going to pay the liabilities first. Within that, there is a hierarchy of which liabilities get paid, before others, right? So secured debt tends to have a priority, and then we pay our residual owners, right? Now, that's a very simple capital stack. It's a little bit more complicated than that because there's a bunch of stuff that resides here in the middle, okay? And which are instruments that people have created which have debt features and equity features at the same time. So sometimes people talk about mezzanine debt. Somebody threw mezz debt around the other day, mezzanine debt. So mezzanine debt is debt at the end of the day, but maybe it's not like traditional debt. Preferred equity kind of sits in, or preferred stock kind of sits in the same place. It is a residual interest, but it has debt-like features. So preferred stock, to your point, is equity. So it is a residual interest, right? So it is subordinate to debt, but it has typically a fixed coupon associated with it. So very similar to a bond or a mortgage, it has a fixed payment. And by the way, REITs use a tremendous amount of preferred debt, and so it's considered equity when you start looking at ratio analysis. So in a way, from a financial engineering perspective, it makes the company look a little bit more solid, and to some extent it is a little bit more solid because the obligations are subordinate to debt, okay? And ultimately it's all about whose money's at risk. We'll do some next week. We'll do a little bit of financial analysis, but ultimately when we take a look at things like debt to equity ratios, what we want to know is who's at risk here, right? Are we playing with, I love this word, right? Or this acronym, OPM. What's that? Other people's money, right? So I mean, to the extent that we can play with other people's money, that's great. The question becomes, what are we giving up in exchange for playing with other people's money? But so, it's great to play with other people's money, but if you're a creditor, you want to know how much money the sponsor, the developer, the promoter has at risk, okay? Because that implies commitment, right? We'll talk about some of those things as we go on in the class. So So preferred stock, so in this country, preferred stock tends to have typically a par value of $25. It doesn't have to be, but I would tell you probably 90% of the preferred stocks out there have a par value of $25. The coupons are all over the place. I would tell you today the coupons on preferred stock are probably sitting somewhere between 4 and about 10%. And there's 2 or 3 industries that tend to use them. Financial services, banks, okay, REITs, and lately you see industries that are in distress tend to use them. Shipping lines are using them. So all these shipping companies and a bunch of energy companies. Okay, so what they're trying to do is give people some debt-like features, a fixed income, a fixed income component, without necessarily being on that side of the capital stack. Mezz debt lives here, but whereas preferred stock would be more like equity, mezz debt is really debt, and it's just basically subordinated debt. Okay, so it typically is subordinated or junior to everything else. Okay, and this is not a capital markets class, and we're not doing instruments, but I at least wanted to sort of mention that a little bit. Any questions, Oz, of that?
No,
Jack?
Why would a company go out in the credit market, borrow money when they have a ton of money sitting in the balance sheet? Now,
Well, I mean, they may not have a ton of money sitting in the
no,
balance sheet.
I have the case like, Apple,
Okay,
for example.
Okay.
2 years ago, they go out in the credit market,
and borrowed $100
borrow
billion.
money to finance some repurchase or something like that, but repurchase stock, and that sent the stock high. But I try to understand this, but
Yeah.
I didn't.
Well, I mean, some people didn't, but I mean, I can tell you it ultimately goes to playing with other people's money. And I'm going to do something in a second, which I think will answer that question. But let me get into that. So, let's bring it back to real estate for a second, and let's talk about REITs and why REITs go back into the capital markets all the time. Okay. A little bit of history. So we've had several high-profile IPOs the last few weeks, right? What was the one last week? Uber. A couple weeks before was Lyft, Pinterest. Who's coming down the line? We'll talk about WeWork in a second. WeWork's coming down the line. We got all these IPOs, and we already figured out that if as individual investors we get allocations, that's not good. That's not good because you're just not big enough to really get something that's good. Okay. So I wish we could spend a little bit of time going through the whole underwriting process because that's all kind of fascinating. But so what happens is in this country, most companies never go back to the capital markets after their IPO. Listen to what I just said. Most companies will not go back to the capital markets after their IPO. Why?
Because they got money from the IPO. Then, if they go to the capital market, they're going to give the intention that they don't have.
Yeah. So hopefully they have raised enough money so the company's mature enough that with that capital that they're bringing in, it will get them into a position where they are mature enough that they're generating enough resources that they can compensate shareholders, but retain enough, we'll talk about retained earnings, retain enough equity in order to finance the growth of the company. Yeah, so, cost of capital is important. We'll talk about that in a second because there are differences between, and there is a very significant difference between debt and equity. I'm going to get into that in a second, okay? And presumably, I think just intuitively, in today's realm, equity is more expensive than debt. And I'll show you that in a second. But more pragmatic than that is, as a shareholder, if you go and do an IPO, and in that IPO you issue 100 shares, right? That means every share is worth what percent of the business? 1%, right? What if you go back to the market and issue another 200 shares?
2%.
So you now are diluting this ownership interest. It's kind of like what inflation does to you, right? Now all of a sudden what used to be worth 1% is worth 0.5%, right? So if you're a shareholder, do you want to be diluted?
No.
Okay, that's what I alluded the other day. I was very upset with an investment that I have because they brought some new investors in and I was diluted. Now, typically in this country, if not by contract, just by business practice, we typically have something that are called preemptive rights. And preemptive rights allow shareholders or give shareholders a right to pony up their pro rata share of any capital, any additional capital call or share issuance or rights offering, so you don't get diluted. So if you don't have the capital or don't want to put it in, you don't. But just as a common courtesy, if we're all partners, right, one of the things to look at each other is, I mean, if you own 1% and all of a sudden, I offered Aaron an opportunity to reinvest in the business and not you, you'd be pissed, right?
Yes.
Right? So, one second, because I got a question there from Nathan, and we'll come to you, Kyle. Yeah?
Can you explain really fast again how that dilutes it again? I didn't quite.
Yeah, so if you own 1 out of 100 is 1%.
Yeah.
1 out of 200 is
0.5%.
0.5%.
Okay, but I get that, but I mean, so they issued 100 shares
Right.
of a stock. So basically, then they sold twice as many shares.
No, so they sold 100 now. A year later, they go back and sell another 100 to raise another 100.
Okay.
And you don't participate.
Oh, I see.
Now, obviously, if you participate, you don't get diluted, but now you've had to put additional capital in.
Yes.
Okay.
Okay? So the reason companies don't like to go back out again, or why shareholders don't want companies to go back out again, is because it's dilutive. And you don't want to be diluted. Now I'm going to keep going with the argument. Kyle,
That's
you
not the
have...
same thing as splitting, though. That's not the same thing as splitting
That has nothing to do with what could be, stock splits or reverse splits. No, because a stock split or a reverse split is all you're just playing with the denominator and denominator at the same time. Kyle.
You kind of answered that.
Okay, all right. So in this country, it's not viewed well. Now, so let's talk about real estate. So what did we say a REIT? So a REIT is this preferential tax selection. We'll talk a little bit about that, right? But a REIT, in order to maintain what the probably single biggest or the most critical one of the rules or the compliance items that it needs to keep in order to maintain its REIT status is to distribute what? 90% of what? No, not cash flow. We don't talk cash flow. What is that? That's not an accounting term.
FFO.
No.
Okay, I was wrong that time.
Okay, that's okay. But you're trying. You're trying. You're trying.
Net income.
Net income. Of net income. Okay? So what happens if you distribute 90% of net income?
You have 10% to invest.
Okay, and how do you grow?
It's impossible to go, almost impossible. You have to go out and borrow
Well,
money.
so the only way to grow is, if you're a real estate business, how do you grow?
Reinvesting.
Okay.
Well, you have no money to
getting-
reinvest it, right?
or
By
securing
acquiring
capital.
more buildings.
Oh.
So how do we grow revenues in real estate? We increase occupancy, we increase rents, or, well, I mean, these two hopefully increase value, but there's a whole bunch of other things that impact value. How do you grow net income? You increase rents, you increase occupancy, price and volume, right? So how do you increase, revenues? Price or volume? That's in any business, right? Sell more units or price them at a higher value. Now, the only other way to do is have more assets, right? So increase your square footage, increase your capacity. How do you do that if you're distributing all your earnings?
You have to borrow more money.
Take debt.
Debt.
What happens if an investor, this guy's playing with too much other people's money? How much leverage can you have in a real estate business? We talked about that the other day. How much can you borrow? So eventually you hit that debt ceiling pretty quickly. Because people are going to say, yeah, we'll loan you money, but I'll give you 70% of what you buy, but you got to put in 30%. Or in the context of core assets, which is what REITs would own, I mean, they'll give you 60%. So in the REIT realm, what Wall Street has kind of said is look to the other side and said, hey, you know what? We're going to let you issue preferred shares because it's like equity. It's like borrowing money, but it really is equity, okay? And there's no priority here. The creditors are not being impacted negatively. I've got a current event thing we'll talk about rating agencies in a second, but so REITs are able to issue preferred shares, and you look at PSA, public storage, you know, those orange boxes you see everywhere. I mean, those people have like 15 different issuances of preferred stock, and the companies aren't really penalized for that by the investment community. So they are used in certain industries. Banks use them a lot as well, okay, because it can be used for their calculations or some of their calculations of capital, their capital percentage, or capital requirement, right? And it doesn't penalize that. Yes, Oz?
But that has to be disclosed in the 10K, right?
Everything's disclosed. All of that's
And,
disclosed.
but it lists the total amount in each class?
We're gonna go through a 10K in a little bit, and you're gonna go through a 10K in a lot more detail this week as part of your case study. So you'll be able to see that directly. Financial statements, I don't want to jump the gun, but financial statements have different components. You disclose your equity in the balance sheet, on the face of the balance sheet. Most companies that have complex capital structure will have a statement of shareholders' equity, and we'll do a roll forward or a 10K analysis of all of their different equity accounts, and definitely in the footnotes, okay, and you become intimately familiar with all this stuff. In the footnotes, there will be detailed information. In addition to that, on the 10K, there is a section which you will see later today, which details a company has an obligation to address on the face of it what securities are covered by their filing, but also what the price performance of all those different issuances has been. Okay. So anyway, I'm not going to do this today. I'm just going to make the observation tonight. God gave us a lot of tools. He gave us a brain. He gave us computers. He gave us Microsoft. Gave us Microsoft Office, and within Office gave us Word, Excel, PowerPoint, Access, Publisher, and all these other tools, right? We should use a tool that is most appropriate for the application that we're doing. Okay, so we'll get into the case study today, but if time permits in this class, I'll do like I'll do a little sort of Excel. I'll do like a 1 hour Excel tricks that I've picked up over the years that might be helpful for some of you all. And I'll do some Word, but some some PowerPoint, but mainly Excel. But use the tool that's most appropriate. If you're going to do math, use Excel. If you want to put Excel into a Word document, you could do that. But doing a table is not the way to work with numbers. So a table is to put text and and all that stuff, but putting numbers in a table in Word, bad. Okay, so we'll use the tool that's most appropriate. There will be case studies here where Word is more appropriate, and there will be some where Excel's more appropriate, and some there might be combinations. And so, in that case, you work with them. Okay. Anyway, where's the 10-year Treasury today?
2.26.
2.26, yeah. Anybody else? Anybody else? Nobody knows. 26? Well, I don't know. I had to write it down. I don't remember these things. I had to write it down. At 4 o'clock yesterday, I don't think it's traded. No, it's not 220. I think it did go down into the 220s during the week, but it closed yesterday at 2.39. Is that higher?
Lower than it was last week?
Last 2.26.
That's what the Wall Street Journal site said. I mean, I don't know. Call Mr. Dow.
On Thursday was 2.26.
Yeah, but it changes every day.
I know.
So my question is that higher or lower than the week before?
Higher.
Alright.
No, wasn't it
It's lower,
242?
it was 2.467.
Oh, it's lower.
245.
Well, somebody checked their notes or remembered. It's lower. And it actually went a fair bit lower. Where's the boom? What's the boom?
Because trade war.
The boom.
The trade boom.
Yeah. Okay.
I'll be honest, I don't know what this either.
Okay. It's the 10-year German sovereign debt. bond, the Bund. B-U-N-D-T. Where is it? What's it yield today? A 10-year German government obligation. What does it yield?
It was 1 point something.
How many years ago?
It's probably
Should it be
less
lower or higher than what a U.S. government? So this is risk-free debt in Germany. Should it be higher or lower?
Should be at par.
Lower because?
Because it's
Higher
it's
because?
risk-free. I mean, it's
Okay, but if it's risk, but is it?
they are
is-
part of the U.S. government sometimes.
But should it? Is their economy? Is their government? Is their source of repayment better or worse than ours?
Worse than ours.
Worse.
Worse than ours.
You think it's worse?
I mean,
Some people think it's better.
We have a,
Europe is worse than.
Well, the market has. Listen, I'm not going to disagree with you, Jack, because I won't be here all day. No, I'm not going to disagree with you. But the market has an opinion on it. So we're at 2.397. We already talked about why this was important. Okay? And so, would it surprise you that the boom is trading at a price to yield a negative 0.1%?
Negative.
So you give them 100,
They give
and in
you
10 years they return 99.9.
Wow. Because it's too.
Where's it? What's the 10-year Japanese bond sovereign debt?
Negative, what's it called?
It's negative as well.
I don't know what it's got a name. I don't know what it's called.
It's negative.
So like the English one is called the gilt, by the way.
The gilt, that's funny.
So the Japanese is yielding negative 0.5%. Why would people buy risk-free debt at less than par?
They believe the value of their money is going to go down faster.
Because
They're like scared, like
of the
They're
US
scared.
the dollar, though.
they're scared not of the dollar, they're scared of their own economy. They would prefer to have 99 for sure, right? They would prefer to pay the government for security than to lose their capital in something else. What does that imply about the perspective of an economy?
Damn.
Not good, is it?
Not good.
Not good. So in this country, maybe we think that it's better. What's inflation in this country?
Cost of goods. Oh, the current percentage.
What is inflation?
Inflation
it's
is,
increase in prices.
The increase of
It's an increase in pricing. Let me flip that. How about it's a loss in purchasing power?
It is.
Okay, so yes, it's an implication that prices rise, but ultimately that means that the individual unit you're holding is worth less today. I'm sorry, it's worth less tomorrow than what it's worth today. Okay, so where do we peg inflation in this country? What should inflation be, or what is it?
It should be,
I mean, we need to know that. Every lease in this country's got some sort of CPI, Consumer Price Index. We need to know this stuff. So when we're modeling, Brandon, when we're modeling, how are we going to model bumps in a lease income if we don't know what inflation is? It's inflation.
Targeted 2%.
Who targets it to?
Fed.
Okay. Now what is it in real life? I don't know what the Fed does or not. But so look, historical long-term inflation in this country is about 2.5% with very little volatility. Very little volatility. And we're pretty much in that spot, or that sweet spot today. What does that imply about your real rate of return that you're getting on a 10-year treasury today?
you're losing.
Negative.
You're getting negative. So we're in the same boat. We're not as bad a boat as they are in Germany, because in Germany they're at a minus 2% when you, okay? But what do you think the implications are from the market about the perspective of the economy.
Going worse.
Well, they're not bright, right? They're not bright. So when the 10-year Treasury drops from 2.46 to 2.2, kind of rebounds to 2.39, I mean, people are concerned. People are concerned, right? And more concerned, so I showed you the other day about, we talked about the term structure of interest rates, right? And we talked about how what is probably a healthy, assuming the liquidity preference is in play, we talked about an upwardly sloping yield curve, right?
Yes.
Where's the yield curve today?
Keep going higher.
So, I mean, what were you guys doing in your office yesterday afternoon? I was sitting here doing that. You guys weren't doing this? Aren't you interested?
Good what?
You had what? That was my work, you know? Because we got to know. How do we make decisions about what? Are we going to build something? Are you going to cut a project loose today? You're delivering 3 years from now.
Oh, yeah.
Are we going to pay you to do planning? Yeah, but what? So did I lose all my money? So the bank takes my money in 2 years? Am I going to pay for an architect? Or am I just going to squat with my money?
And you get into a recession.
So, anyway, kind of curious. The 1 month Treasury is at 2.39. Imagine. The 1 month is at the same place as the 10-year. The 2 month is at 2.4. The 2-year is at 2.0. I'm sorry, 2.20. So you've got inversion there. On the short end of the curve, you've got inversion, and then it kind of flattens out because we know that at 10 years, so at 5 years it's 2.17, right? And then 2.39. So we kind of have a yield curve that's going like this, okay? But it's like inverting, and again, historically that doesn't bode well. When people see that much uncertainty, that longer term rates are yielding less than shorter term rates, people are saying, hey, we see a lot of uncertainty in the short term. Now, I brought this thing the other day. I was reading Bob Farrell's rules and I forgot. I started reading some of them and I forgot. We talked about mean reversion. We said markets tend to return to the mean over time. Excesses in one direction will typically lead to excesses in the other direction. There is no such thing as a new era. Okay? Excesses are never permanent. So, all these people on TV that are telling you, the paradigm's changed, you know? I mean, you can believe it, right? Exponentially rapidly rising or falling markets usually go further than you think. The public typically buys the most at the top and the least at the bottom. Fear and greed are stronger than long-term resolve. When all the experts and forecasters agree, something else is going to happen. Okay? So it's like, if everybody's be careful, okay? All right. And bull markets are more fun than bear markets. We know that. Okay, so anyway. So, you know, we gotta keep our eye on the Treasury, on the 10-year Treasury, because ultimately it's the benchmark rate under which we will hopefully make decisions as to whether to buy, to sell, to refinance, or, and I'll get to you in a second, or going back to the point that I talked about, and I'll take a break there. We gotta understand our WACC. We don't want whack, right? Like that guy's whack? No, I mean, what's whack? Our weighted average cost of capital. And I want to review that. It's not part of the course, but I want to review it. Hold on, Jack, you had a question.
Based on these indications regarding the yield curve and stuff like that, what would you say to someone who's having a 5 years horizon on the project that they want to start today? And I mean,
well, 5 years is probably okay, right? You know, I'd say 2 to 3 years is probably, you know, I'd probably be me. This is me. This doesn't mean I'm right. Okay? I would probably be a seller today more than I would be a buyer. and I would probably be more likely to raise cash and look for opportunities in the near term. To your question, why would Apple borrow a bunch of money today? Well, rates are low. They can borrow money today and sit on it instead of borrowing money tomorrow, right? So if in the context of real estate, you've got strong cash flow, credit markets are still good, you know, maybe it's a good time to refinance, get some cash out, okay? And so, you know, take a look at projects that maybe you can hold and go through a market analysis slowly. Maybe look at assets that have some component of cash flow that then you can redevelop. So that's what I would do. So, you know, from my perspective, I wouldn't go crazy doing a bunch of, you know, greenfield development right now, looking for sites that, you know, likely are going to, you know, take some time to really get off the ground. And you know, you know, there's cycles, right? And so we all wanna hit, right? So like we don't want to buy here, right? We kind of want to buy, but we don't want to buy here. We kind of want to buy here and start developing and be the first guy to deliver in the market, right? We definitely don't want to buy then here because then we got all the way to go down. But the problem is there's a lot of risk here, right? So, and depending on the project, depending on all the regulatory components that, you know, you've got to go through, you know, a normal development could be at a very shortest of terms, I would tell you 18 to 24 months, but you're probably going to be 36 to 60 months out, okay? Again, depending on what you need to do. So, I would just, that's what I would do, okay?
Okay.
So
Yes.
why don't you want to buy
Up here?
No, all the way to the bottom.
Well, you know, I probably would want to, why I wouldn't want to buy all the way at the bottom is because you never really know when the bottom is, okay? In stock investing, people talk about something called like dollar cost averaging. So, since you never really know when the bottom is, you start buying little slivers of stuff, right? You know, going back to, I think you asked a question about price discovery. Was that you the other day? Somebody asked about price discovery. Why I really want to buy a little bit further up because hopefully I've got some validation there that a floor is in place and things are starting to get better. Okay, that's why I would say I'd rather be there than here, because this could still keep coming. Now, it could do that again, okay? The fact that it's coming back up doesn't necessarily mean it's going to keep going up, but hopefully I would buy when there's a little bit of, again, that's my risk, you know, temperament. I'd rather make a little bit less, but have a little bit more certainty or security, okay?
So about the raising cash thing, I mean, in 2009, I had an experience. I sold a house. I sold a house and I refinanced that house and set aside the equity line of the bank. At my surprise, I went to the bank. They closed my equity line.
Well, so I mean, you got to understand whenever you enter into a credit agreement, you need to understand what the conditions are, and the fact that you have a letter of credit, or sorry, a line of credit doesn't necessarily mean that it's going to be open perpetually. You know, so again, that depends on your agreement with the bank, and it also depends on the bank's condition too. So, what's weighted average cost of capital?
How much do you want to cost?
Your money. We define capital already, right? So we didn't say your money, we defined, so it's what the cost of your capital is, right? The capital is the debt and equity that supports your assets, right? And so I want to say that there's three general components to that, and what would those be then? So it would be the pro rata share, I'm just going to say pro rata share of your cost of debt plus the pro rata share of your cost of preferred stock, right? Or mezz debt, right? Plus your pro rata share of your cost of equity, okay? And so, let's just imagine a balance sheet that has 3 in assets, and it has 1 of debt, 1 of preferred stock, and 1 of equity, right? So it would be 1/3 my cost of debt plus 1/3 my cost of preferred stock plus 1/3 my cost of equity, right? How do you calculate cost of debt? Your KD. What's your cost of debt? Pretty simple.
Interest rate and
So it's the weighted average interest rate on all of your debt outstanding, right? So you got a mortgage at 5%, one at 6%, one at 7%. They're each for the same amount of money. What's your average cost of debt?
Average is
divided, all of this debt divided by their, you know.
So if they're all the same, you could just say 6.
Yeah.
5, 6, and 7. It's weighted average rate. So, but is it that simple? So it's 1/3 times 6.
Percentage of debt to the overall capital.
We'll leave that blank for now, because we're not done. Let's assume that we've got preferred stock that has a coupon of 6% on it. So what's it going to be? 1/3 times 6%. Okay, plus 1/3 times. Now, what's your cost of equity?
Return on ROE, make it return on equity. Is that what you're saying? Thinking about it.
It's funny, I had a former player in my office yesterday preparing for an interview he's got, and he gave me the same answer. And I've never seen that. So, I mean, obviously it comes from somewhere. People use something else as typically the cost of equity people relate to CapEx. Okay, and I'm not going to get into that because that just takes us too far, but that's a capital asset pricing model. Have any guys seen that before?
Yes.
Yeah? No?
That's the.
So it's your expected return is equal to your risk-free rate plus return on market less your risk-free times beta. Right?
Yeah.
What's
I'm
beta?
kidding, I'm kidding.
Beta is the.
Beta is a measure of systemic risk. It's, you know, it's undiversifiable risk. Now we can go further, but
Keep going.
but some people use the Gordon growth model. Maybe some of you guys have seen that if you've taken like a capital markets class or a capital budgeting class. But there's formulas out there. I can also tell you that in a practical world, when I worked at a publicly traded company, one of the things that we like to do was to define what our WACC was. And we actually took a look at what we perceived their cost of equity would be. We had a kind of bizarre capital stack. We had some very legacy assets that had no debt on it. So we could have calculated an expected return given our parameters, but it wasn't really realistic given the opportunity cost of what those assets were truly worth. And so we actually just looked at peers, and we kind of just created our own cost of equity given what the market was. So, I mean, there's no real way of doing that, but some people might say, well, it's the dividend you pay. Well, it's not just the dividend that you pay, okay? It's not, but dividend to some extent is, comes back to Gordon growth model. So it's what you have to compensate your shareholders, okay? And ultimately, that talks to what their expected return is, which is some sort of risk premium over the risk-free rate and a variability or the volatility that they're going to have versus the market. Okay? I don't know if that makes any sense or not. So let's just assume that in today's realm, let's just use 10%. Okay? Why did I say that? I mean, that's a good number to grab out of the air. It's probably a little bit lower today. That's probably like a pretty realistic number. Commercial debt today, probably closer to there. This is probably closer to here. Now notice how, curiously, as you go up the capital stack, or down priority in the capital stack, the cost of the instruments go up. And I'm just giving you some sort of indicative numbers today. You know, this is just from my personal experience, right? Now, so that's one thing. So credit risk or risk of default or risk of loss has a cost associated with it, right? So looked at from the creditor or the equity holder's perspective, right? There is definitely a risk-reward profile, okay? It's not just as a company underwriting a project, more risk, more return. Well, if you're going to put your money into something, the more risk, the higher return you're going to demand or expect, okay? But there's also, up until now, there's also a critical division that exists in this country between debt and equity. And what's the difference from a tax perspective?
Double tap? Something of that.
Interest is
It's
a
deductible.
deductible expense. So you don't pay tax, okay? Whereas dividends, well, you don't pay tax, you pay dividends with after-tax dollars. And then shareholders typically have to pay tax. Now, you know, there's a whole bunch of, that's why we, in tax classes, we don't typically, in the real estate classes, we typically think of frictionless, tax frictionless environments. So we don't usually talk about that, but, so really, the weighted average cost of capital is debt times, you know, your pro rata share of debt times 1 minus the tax rate. Because the government is essentially paying a portion of that, all right? And so, in today's environment, what's a third of 5, like 1.67, something like that? Is that what it is? So, let's say the tax rate's 50%, just to make it easy. So let's just say that 0.75 plus what's a third of 7, like 2 1/4. Let's just call it, to make the math easy. Plus what's a third of that? Let's just call it 3.
Something.
Call it 3.525. It's 3.33, but just to make it easy, 2. So that's 3, 6.5. So in today's environment, a company that has the ability to overlay or finance their assets sort of equally across the capital stack and has fairly good credit is probably going to have a weighted average cost of capital somewhere around 6.5%, 7%. You could do the math for all these. I'll tell you, you can find for publicly traded companies, you're likely going to have somewhere between 7 and 12% is probably going to be the weighted average cost of capital today. Okay? Now, why is all that important, right? At the end of the day, in the context, I mean, some of you guys have had real estate finance and investments already. Have you guys done net present value? You've done net present value. You have? Yes? Some of you have. What is net present value?
That's the present value of all future cash flow.
What is the net present value, Jack?
That's the present is the present value of future cash flow.
It is the net present value of your future cash flows. Now, in the context of capital budgeting, when you make an investment, when your net present value is what?
It's
Anytime your net present value is greater than 0, it's a go decision. Right? Now, at what rate do you discount the cash flows, Jack? What discount rate do you use?
discount rate. It's hard to be better than your internal rate of
I didn't
return.
ask you if it was better. I'm asking you at what rate.
Okay, that's it.
At what rate? So we know what net present value is, but at what rate? So
Let's
we
say 6%.
take our calculator, or we use Excel, and it says I or R. What do we use?
Whack.
We don't use WACC. Because we're looking at this on an unlevered basis. So since we're looking at it on an unlevered basis, what will we look at? Our cost of equity. Okay, so it's a component of WACC. Now,
15%.
I'm talking about theoretical. I'm talking theoretical. All right? Now, is capital limitless? Can we make all the net present value decisions that are positive? Do we use net present value in real estate? Yes? Yes, we do? Yeah? Yeah, I've never seen it, but we use it indirectly. We use it indirectly, and it's where I'm going. We do use it indirectly. Because the reality is capital is not limitless. So it may be true that every investment you're looking at has a positive return, but you may not have the capital to do all those. So then we use a different technique, and we use it in real estate, which is called what?
Internal rate of return.
IRR. Internal rate of return. And what's the internal? And so we use this for ranking. So in theoretical capital budgeting, we invest in the highest IRR, then the next one, and so on until we run out of capital. But what is IRR? What's internal rate of return?
It's all.
Cash on.
Cash on cash. What the hell is that?
It is the return.
You hear IRR.
Cash on cash.
It has to be better than the cost of capital. So whatever you decide to, if your internal rate of return is better than what you're going to pay.
You're giving me comparability again, and I'm asking you what the definition of internal rate of return is. So it is a return on a cash flow, right? It's a project return. But specifically, IRR is that rate at which net present value is 0. Okay? So so the discount rate at which the net present value is 0 is the internal rate of return. Okay? Yeah? Now, to your point on do you use WACC or don't you use WACC, what happens is, in theory, in theoretical capital budgeting, we should always take a look at cash flows on an unlevered basis. What happens in practice and in real estate? What did I say the capital stack was what? 70% debt? And so what happens is people in real estate take a shortcut and they look at levered returns, okay? Okay? They look at levered cash flow and they discount that levered cash flow, okay? And so by looking at levered cash flow, you're implicitly in your analysis coming up with what your cost of debt is, right? Now we already said that the cost of debt was significantly lower than the cost of equity, right? So the more debt that you can pile on, the higher return you're going to have. Okay? Questions? Thoughts? Ideas? Does any of this stuff make any sense? Should I, like, you guys want to talk about accounting or? I mean, listen, look, like I know this is like a lot, right? Is this a lot?
Yeah.
It's just different with finance.
It's different what?
I mean, it's not, the rules and principles of accounting are completely different than finance, and we're all.
Well, and so, yeah, so, but I like to bring stuff that maybe we don't otherwise, yeah, so, you know, my is kind of curious, my undergraduate is in accounting. I have a double major in accounting and in finance. And my master's is in finance, okay? And so the way I kind of look at it is accounting is more historical and finance is more prospective, okay? And so obviously there's going to be a set of rules for how you accumulate data, and there's a different set of rules on how you project data. And in real estate, because we're starting at ground zero, we're going to look this way, right? Now, if we want to analyze how we did, you know, at some point we got to take a look at accounting and understand. So we got to understand both worlds, okay? Because if we don't understand history, we can't look at the future, okay? Just a few other little things before we get bogged down in other stuff. All right? This is a great. I don't know. I get these briefs every day, and this briefing service that I use. By the way, if you guys are interested, there's a service called Smart Brief. Take a look at that. Smart Brief. Smartbrief.com. So there's a company out of Washington, they do about 300 different daily briefings. They're free. I say daily, some of them are weekly, some of them are bi-weekly. And they tend to be industry focused. So I've signed up for ones that they do jointly with the AICPA, they do it with the with the chartered financial analysts, and I do some that they do with REE, and some that they do with ICSC. So, you know, you get all kinds, you know, they've got some for construction industry, okay, so it might be an interesting thing, and you're going to get, like every day, you'll get a 3 or 4 page summary of stories that they've gone out there and found that, you know, may be of interest to you. So, they always have a saying for the day, and it says, to get to the top is easy. To stay on top is hard. Okay, so I just, I'm not going to do this one today. Okay, I'm only going to make this comment. I'm not going to go into it because you gotta like take in. So there was a report this week. U.S. births fall to the lowest level since the 1980s. Do we know what the fertility rate is in this country right now?
2.
No, so what's zero population? That was like when I was a kid. People talk about zero population growth, ZPG. So like if you got like a couple, like 2 people have a kid, right? How many kids do you need to replace those people? 2. So zero population growth would be 2, right?
Yeah.
Probably a little bit higher than 2. It might be a little bit less than 2, right? If people are living more, maybe you could get away with a little bit less to not grow the overall population, right? If people are dying younger, then you probably need more. But you got to be around 2, just conceptually, right? What is it today in this country? I mean, I'm getting close to like where I can tap into Medicare and all that kind of stuff, right? Who pays Medicare and Social Security? You guys, young people, right? I work at a university. What's a university depend on? Young people. Young people. Birth rate in this country is 1.7. 1.7. Go to countries like Japan, where the birth rate has been well below 2 for many years, and you start seeing the societal implications on pensions.
The economy.
Yeah, exactly. And then, again, look, so that's for us to figure out, right? Why are people having fewer kids? Why are people waiting longer to have kids? And then, just because there's a lot of other sort of, there's a bunch of other moral, implications on all this stuff too, of why that's happening. But immigration plays into this, right? And ultimately, the one thing that we can think about is in real estate is how does that impact what we do, asset classes. What, fewer people, fewer household creation, less multifamily, right? What are the implications on workforce? Where are we going to get our people, right? So there's a lot of different, but we got to track all this stuff. And this is stuff that has an impact, not tomorrow, but 30 years from now when you're my age. And you're going to be dealing with that professionally still. Okay, so got to keep an eye on that stuff. Fannie and Freddie back more mortgages of those deeply in debt. Okay, so what's Fannie Mae and Freddie Mac?
Federal agencies.
Government-backed.
Quasi-government entities.
Government-backed, quasi-government.
Those are federal agencies that back mortgage in this country. Those are federal agencies that back mortgage in this country.
They are federal agencies that back mortgages in this country. You're getting closer. You're getting closer. I mean, we need to know, Fannie and Freddie ultimately support the housing market in this country and support essentially all the multifamily development in this country. So without their existence, there's no multifamily in this country. Without their existence, we don't have a home ownership rate of 65%. Fannie Mae and Freddie Mac were originally government-sponsored entities, GSEs. They they were privatized, they were made public. They provide direct credit and are highly involved in securitization of mortgages primarily related to housing, whether it's single-family homes or multifamily development, okay? Those entities had an implicit government guarantee, and I say implicit because the government never stepped up to actually support it. But then they kind of explicitly did in 2009, and so what, those two entities, we own those two entities now. Those are, they are in conservatorship right now, and they're basically controlled by an agency within the Department of Treasury. There's still some minority shareholders out there that got diluted when the government came in. The government came in and did a preferred stock offering. And so, but these entities provide direct loans to developers and purchase mortgages on the secondary market, package them, and sell them as securitized debt to investors. They provide liquidity in the housing markets. So I'm not going to get into that. That's an incredible discussion to have, but we've been in limbo for 10 years, and we've had 3 administrations say they're going to do something about it. There's been 3 white papers, and we don't know what's going to happen. But what is important here is an article that I read said, seriously, underwater U.S. properties are on the rise, and they define seriously underwater mortgages that are significant as being 25 mortgages whose mortgage outstanding is greater than 25% of the value of the home. Okay, so what they're estimating today is that almost 10% of mortgages in this country are underwater. But I couple that with another argument that says that Fannie and Freddie right now are essentially acquiring and then packaging mortgages. 30% of the mortgages that they're packaging are the homes whose household income, okay, or whose mortgage and debt payments exceeded 43% of household income. So stop to think. You make $1,000 a month, you're paying $430 a month in mortgage. Can you live? No. You probably can't. So the implication there is not only do we already have a significant number of mortgages underwater, 30% of what we're originating now is probably likely going to be at risk somewhere in the future. So it's kind of like the cycles we go through, right? And greed. So we have a crash, nobody can get credit. Spigots are cut off. Your home line's cut off. Nobody can get a mortgage. All of a sudden, 10 years later, now we're starting to see a relaxation of credit standards. Okay? And so what are we going to see somewhere down the line? Maybe 5 years from now, an increase in delinquencies, right? And which is going to have implications on pricing, etc. So these are tea leaves to read. This isn't going to happen tomorrow. It may not even be that perceptible to us. But at a certain level, somewhere down the line, there's going to be implications to this. Okay? People are going to have some of that. Now, there's another article. Fannie and Freddie overhaul could have a significant impact on the apartment sector. Yeah, but we don't know what's going to happen. Bush, Jr. or W or whatever his name was, or 43 or whatever they called him, had a plan. Obama had a plan. This guy's got a plan, but nothing's happened. Fitch ratings. Who's Fitch? It's not a movie guy, it's Fletch.
It's an agency that grade.
Rating agency.
That's a grade.
What's a rating agency? What's a rating agency? Yeah, Michael?
That's our agency.
It rates. Hold on, a rating agency rates. Give the band a star. What does it rate?
They're rating
The bonds, for example.
security.
It rates like bonds.
Security.
Securities, probably credit more.
Kind of like Standard & Poor's, they're kind of like a...
Well, not like, kind of. So there are 3 large rating agencies in this country. Standard & Poor's, Moody's,
and the one, Fitch.
So what they...
Fitch, there's another one called Kroll. But these guys got 95% of the market. What do rating agencies rate?
They kind of set
That
a
was-
standard for what the values
That
of.
was a credit of, if you said that the mortgage is, the people that bought the mortgage,
They don't look at mortgages, they don't rate mortgages per se.
They rate businesses. The securities that.
They would rate debt instruments.
Yeah.
They may rate securitized debt, which is backstopped by mortgages.
That's right.
But ultimately, what they are rating is an entity's ability to provide the cash flow to repay you.
That's right.
Okay, so they're going to look at company specific. They're going to rate based on company specific factors related to repayment, right? So they're going to look at existing cash flow. They're going to look at overall corporate debt, etc. So just important for us to know, because rating agencies are an important part of the enhancement that's required in the ultimate cycle of real estate financing today, okay? Because most securitized debt and a tremendous amount of residential and commercial securitized debt is rated. And that gives, ultimately that rating talks to default risk, okay? And so people's willingness to buy that is going to be based on what, and so they've got I've got a spreadsheet I put together. I'm not going to share it here, but you can imagine that A or AAA would be good, and C minus,
Not good.
you could just think about your personal experiences here, okay? AAA, good. CCC minus,
No good.
not good, okay? And they do draw a line. There is one significant line that they draw somewhere around triple B minus in the case of, and they use different, I don't know the Moody's one, triple B minus is the S&P one. No, well, not junk. Now, we don't call it junk, okay? We call this investment grade, okay? And we call this,
non-investment.
well, we could call it non-investment.
Junk.
We could call it junk, but we call it speculative,
Speculate.
okay? And a lot of institutional investors, by default, can only invest in institutional grade instruments, okay? Yes?
Do they all agree on different standards?
Well, so the concept is each one of the companies has their own, I mean, these are public, but Fitch is not, but Moody's and S&P are, well, S&P's owned by McGraw-Hill, and I don't know who owns McGraw-Hill anymore. Ultimately, these are publicly traded entities. They've got their own proprietary method, but ultimately they're looking at company-specific risk and ability to repay debt. And the one thing I can tell you is a very high correlation between their ratings and default rates historically. So they generally do a good, generally, over a 100-year period, have done a good job.
Are they regulated as well?
That's for another class. No, not really. And the guy that gets rated pays them. So are there inherent conflicts? And was there a problem in 2006, 2007 with that? But that's for another class, man. You know, that's we don't do that here. San Francisco limits office space. It says that's a problem for tech firms. So San Francisco's passed a law that says that they're going to limit office space built to 900,000 square feet a year. And that's I mean, you imagine in South Florida, any municipality here, we'd love to have 900,000 square feet of office space built in a decade. These guys are limiting it to a year. And here's an example. So Pinterest just leased 500,000 square feet in a building that is going to break ground in 2020. So you can imagine, looking to break ground in 2020. And they're locking in space because firms right now are concerned. And this is a supply and demand business. Now, it's kind of interesting going back to the importance of regulatory impact in real estate, right? Some years ago, the big issue was, 15 years ago, people were putting up all these data centers and all that. What were they doing? They were going to the downtowns, finding empty buildings where there was a lot of connectivity, hardened facilities, and then cities are saying, we don't want that because there's no people, okay? Now they're saying, hey, let's limit the people here, we don't want that many people. So, you get all these trends, and in different parts of the country, you're going to get different different realities, but we always need to know what's going on because it's going to have impact. So if you're a developer in San Francisco and you've got a parcel of land and you're already entitled, are you happy? If you're an existing property owner and you got a bunch of leases coming up for renewal, are you happy with this moratorium? Yes. Might you even pay, you know, contributions to the politicians that want to get reelected and support it? Of course. If you want to get into San Francisco, not good, right? If you're just closing on a piece of land and you have no entitlements, not good. Okay? So, I took up when, you guys are much too young, but up until about 1980 in the state of Florida, when you studied high school, you had to take at least a 9-week class on communism. Maybe if you guys took that, people like Bernie Sanders and socialism wouldn't be all the rage because you would understand why some of us are here in this country. But leave my politics aside for a second, okay? So when I took this class, I'll never forget, the guy that was the instructor, still a good friend of mine to this day, okay, said, there's two things you need to be empowered. Two things you need to be empowered. What are the two things you need? Well, you need money, right? No, and you need to have, right, you need to have, you need to have influence or be in power, right? You need to be elected, right? Okay? You cannot have one without the other. So if you're a politician and you're not backed by money, you're not going to stay in power too long. And if you got money and you don't have political influence or power supporting you, somebody's going to take your money. Now, that's a very simple sort of analysis, but never forget that if you've got wealth, you better have influence or look for influence, okay, to protect that wealth. Because if not, you get a Bernie Sanders coming here and say, don't worry, forgive all the debt. We'll take it from the rich people. We'll take it from the people that work for 40 years. I mean, so I'm looking at it from a totally different perspective, right? But, oh yeah, forgive all my debt. And I'm saying, what, with my money? I paid my debt back, right? So, you can see how things happen. So I'm not trying to, I'm not saying you guys are against things, but just kind of the argument I hear all the time. Yeah, we shouldn't, why should we pay for anything? And, health insurance free. Nothing's free in life. Got to pay for everything that we do, somebody's got to pay for.
Of course.
And that somebody ultimately is us. Okay, so
That's kind of a simplistic kind of
The what?
way to do it. I mean, you kind of break it down. I mean, everything you do is very complicated, but you made that a simple argument. How is that? I mean, if the insurance company takes 30% off the top of health, they're talking about eliminating that.
look, we've got, guys, this is an important, look, I'm not a health care expert, and there was really very interesting, there's an initiative that 3 big companies have undertaken, which is Amazon, Berkshire Hathaway, and JP Morgan, which between the 3 of them, control a tremendous number of employees, and they've undertaken an initiative to try to address the cost of health care in this country. And the other day I was listening to an interview that Berkshire Hathaway had their annual meeting, and somebody was interviewing Warren Buffett, and he said, hey, what's up with this initiative? And he said, look, he said, this is going to be a long-term problem to fix. He said, because there are a lot of problems with the cost of health care in this country, a lot of problems. And he says that we've come to identify a lot of the problems. The problem is, he said, and it was an interesting analogy, he said, every government dollar that's taken has some sort of constituency attached with it, okay? Everybody wants to get a piece of that tax dollar, right? He said healthcare is the same exact way we found. So there's a lot of different constituencies, and everybody agrees that the system's broken, and everybody says we need to fix it, just don't fix my part. So when we've got doctors in this country that make on average over $400,000 a year, I think we've got an issue there. So yeah, we could say the healthcare companies, the insurance companies, but I mean, you could look at their financial statements, there's very few left, and they're mostly publicly traded, so you could take a look, they're assuming a tremendous amount of risk. I don't think that their ROE is excessive, would be my perspective. You got a bunch of people that go to, you see it, look, I see it with my parents. You're old, what do? Go to the doctor every day. I go to the doctor with them now. What do you see there? A bunch of people sitting there. They got nothing else to do. I mean, I know it sounds, no, but when things are free, when you got Medicare and things are free,
You use it.
you use it.
It's changing the way you pay for it.
Well, listen, and it's addressing healthy habits, and why do people smoke, and why do people drink, and why do people eat bad food? No, I'm just kidding. Why do people eat bad food, and why don't people do sport? And so, but that's for another day. Okay. Anyway, PIMCO postpones $1 billion mortgage REIT. So, So we talked about REITs. What kind of REITs are there? Well, we can say there are public REITs, there are publicly traded REITs, and there are private REITs. So REITs that don't trade in the public markets. But inherently, so REITs generate, one of the other limitations, they can only generate passive income. What's passive income?
Income that.
So income that you're not actively involved in the process of generating. And by law, we've defined that rent is one measure of passive income. What's the other major one?
Interest rate?
So debt issued entities hit. So interest, right? Generated by mortgages, right? And so REITs can kind of broadly be defined as equity REITs, REITs that invest in the ownership of buildings that generate rent, or REITs that invest in mortgages that generate income. We can kind of say there's some hybrid REITs. There's a few, not many left, that do both. Okay? Now, historically, mortgage REITs bought securitized debt. But more and more, there's Aris Capital, Apollo, KKR, Blackstone. At least those four sort of private equity sponsors have created mortgage REITs. Starwood, Invesco, and what these guys are actually doing direct lending. Okay? And so there's something sort of interesting called disintermediation going on. So what's disintermediation? What's the process of breaking up intermediation, right? We're talking financial services. So intermediation is a process by which a go-between, so at a very basic level, you've got savers and you've got users, okay? Savers, who are savers? Old people, rich people, right? Who are users? Young people,
Workers.
poor people, corporations, individuals. And so intermediation is a process by which, financial intermediation is a process by which people loan money, right?
Those who want it, need it.
Those who can postpone consumption,
Those who need it.
give it to the people that need now. So again, that's a whole other class and another concept, but this is the historical model that we have. And what's the basic financial intermediary in this country? A bank, right? So we put our money in a bank, and a bank issues mortgages or makes loans, all right? But now we've got this whole disintermediation process where investors, right, are bypassing the bank. They're investing in these REITs, and these REITs are providing the mortgages, okay? And again, there's implications to that. There's more competition. There's a lot of good related to that, right? Less regulation, right? Less protection for the investors, et cetera, et cetera, et cetera. But that's a process that's happening today. So PIMCO, what's PIMCO?
A bond fund.
Pacific Investment Management Company. It's the largest sort of bond manager out there. It's a subsidiary of Deutsche Bank, or no, Allianz, which is a large German insurance company. They were going to do $1 billion. So they would probably lever that 2 to 1. So that means they would have $3 billion worth of debt financing for the commercial real estate markets. That's a nice slug of fresh capital coming into the industry, but they canceled the plans. Now, WeWork. I'm almost done with this. WeWork. This guy's a bozo. Okay, I'm sorry. This guy is a clown. But people love clowns.
You do?
Yeah.
People love this clown. Adam Newman. Is that guy related to Alfred E. Newman? Who's Alfred E. Newman?
Mad Magazine.
That's
Yeah, dude, it's fine. Somebody the other, I was at a store or something, and somebody's talking to somebody else, and they said, no, Alfred E. Newman, and this girl gets on her phone, and she's like, what is that? It was something called Mad Magazine, or how is that?
Oh, yeah.
Okay, yeah. Okay. This is the guy that started, what's WeWork? What's WeWork?
It's an office space.
Virtual office?
Yeah.
Well, it's not virtual.
No, it's not virtual.
Shared space.
Yeah, flex space, yeah.
They have no office.
People call, no. No, you're thinking about like work sharing or hoteling. WeWork is a company. WeWork is a company that leases bulk space and then rents space inside that to individuals by the cubicle, then they provide service. Now, is that a new business?
No.
I mean, that's existed forever. We've had companies like Regis that have been doing these office suites forever. But these guys come around, they get huge financing from a bunch of private equity. They've got their last round, their last valuation was $47 billion. The largest REIT in this country, I don't even think gets to 10 billion. Okay, I mean, I think it's like a Boston Properties, and I don't even think it gets to 10 billion. Okay, Simon is up there. There's 5 or 6 huge REITs, very valuable real estate, cash flow generators. This guy's valued at $47 billion. Now, I can only give you anecdotal data. Okay, I have a friend who's a broker, who's an office broker in Miami. He told me that the WeWork guy in Miami promised him a commission equivalent to 1 year's gross rents if he brought him a tenant.
What?
Now, these guys are going to go public. Now he says, hey, we're not Uber, we're not Lyft, we're for real. Now, a couple of things you need to know, okay? Last quarter they had revenues of $1 billion. They lost $250 million. So that means you have $1 billion of revenues. I'm sorry, they had $750 million is what they had. Okay? And they lost $250. So they had $1 billion worth of expenses. And they're saying, yeah, we're spending a lot on marketing. Yeah, they're paying these huge commissions and all to get people in. So here's another thing that you need to know about this guy. And here's what's interesting. So this guy's the CEO of the company.
Bozo.
Alfred E. Newman. So this guy personally has bought real estate and financed it by a lease from WeWorks. So personally, he's become incredibly wealthy at the expense of the company. Where do you find that stuff out? In the footnotes of the financial statements under a section called related party transactions. Now, it appears that in anticipation of going public, he's now going to sell those, obviously at a handsome profit, back to the company. That's always been a very tax-effective way for small business people to own real estate. They own the real estate personally, and they lease it to the company. They charge a very market or favorable rent, right, where they're getting money out of the company. They're deducting the expense at the company level, and on a personal level, they're offsetting that income by depreciation on the building. So on a personal level, you're getting cash in, you're not paying tax, and at the corporate level, you're lowering your income. So it's a very tax-effective technique in a small, closely held company in this country, but not for a publicly traded company. So anyway, we got to take a look at this stuff, right? So and people don't focus on this stuff, right? You know, it talks about you know, are these transactions between a company at arm's length or not? You know, and so a huge conflict of interest there. And that's it. I'll skip this one because I wanna move on. So I'm not gonna take the break now. If we take the break now, you know what's gonna happen? We're never gonna get to 12:30. So we'll keep going. We'll talk about accounting now. Yeah. Oh, fun. Yeah. Talk about accounting now. Any questions on any of this stuff?
Are you a CFA?
I am not. I am not. That's a, you gotta make a commitment to do that. That's basically a 3-year route. And you have 3 tests. I probably have enough knowledge and material to pass the first part. I don't want to say easily, I'd have to study a lot. The next 2 would probably, and maybe at a different point in my life if I, you know, thought about it, but, you know, I don't do that kind of work, so. But listen, it's all knowledge, and the more we know, so I had a former student came to see me yesterday. He's got an interview Tuesday. I think it's a great job interview. So it's his 3rd interview. It's at a bank. It's at the wealth management division at a large international bank, and it's with the Alternative Investments Group. And so they like him. He seems personable enough, right? So they're bringing him in with another guy, and they're going to say, we're going to give you, you know, a few prospectuses, and you got to come back to us with recommendations on what we would recommend to our clients. Imagine you'd come in and somebody say, here's some paper, you know, do some sketches for me, or lay this out for me. You know what I mean? It puts you to test, right? Or you're in a development role, right? And you go to Styles and all of a sudden say, here's all these projections. Which project am I going to? Yeah, I mean, so anyway, he came and I mean, I've never done any of this stuff, but just from different stuff that I had, we cobbled together some things to at least, okay, how do we analyze these things, right? So in life, we always want to take a look at stuff that's, you know, that's practical but we need knowledge for that. And so you don't need to be a CFA, you don't need to be an attorney, but it's great knowledge, you know? So that would have been a great thing to have done, gone to law school and just pick up, I don't want to be an attorney, but it'd be great to have that knowledge. So accounting. I'm going to jump ahead and say that, so those of you who turned in your case studies got 100 for turning it in, for doing the work. If you didn't, you didn't. That's not going to happen. It's not the case in all the other ones, okay? That was kind of a Benny. But I would tell you that, again, without being a value judgment, I would say that, and I've got 10 years worth of teaching experience, so sort of general accounting knowledge here is not very high. And you don't need to be accountants, but you need to understand financial reports, okay? And if we don't understand them, it's very difficult for us to analyze them. And we need to analyze financial reports in a lot of different ways. And if we don't want to analyze other people's, what we're definitely going to be involved in is situations where other people are going to analyze our financial reports. I worked with a guy who ran he ran the construction group. He was an architect by training. He ran the construction company at work for a lot of years. Very talented guy. He took over the development business, and after I left, he ultimately became the president of the whole company. But he had absolutely no knowledge of financial statements at all, like zero. And it really hindered his ability to work, and ultimately, it caused him to fail when he became the president of the company. I mean, he lasted for like 9 months as the president of the company because he was working for guys that were financial engineers out of New York. They were private equity guys, and they didn't care about layouts and site plans, and they showed me the money. And he couldn't talk their language, you know? And so, you know, you get by with a project, but, you know, as you start getting bigger, you've got companies, you know, you got to understand this stuff. I'll give you an example. There's and it's a construction company, not a development business. Miller Construction. You guys seen them? Yeah. I mean, Harley Miller had a small little company. All of a sudden, in the last 3 or 4 years, doing our yacht club, he's doing these industrial things here. I mean, so now all of a sudden, you got a small little business. You know, it's all cozy and all that. And all of a sudden, you blow up and you're going to the bank and stuff, and like, can you talk to the bank? How do you grow? How do you go to a bank? And you got to show them you've got some savvy. You know, and then they start talking to you about covenants and things like that, and you're going, huh? What's that? How do you calculate that? What does it mean? Okay? And so, to everybody, I've always recommended, most of you guys should have taken like an entry-level accounting class, and especially those of you who have, a business background, not the psychology guys, okay? But I always recommend taking a 200 level basic accounting class to everybody. You know, go to a community college, do a semester, and you'll learn as much as you need to learn. You know, I can send you guys, by the way, I was really sad to find out the guy who did this book died. But I've been recommending this book for a lot of years to students. No, this guy started the MBA program in Tel Aviv at the university there. And, but the guy kicked ass. He taught it at Wharton, and so he did this book called Principles of Finance with Excel. So if you want to learn Excel and practical applications of Excel to accounting, this is a great reference book. So I came upon it. I had in graduate school, I had an earlier edition of a different book that he did that was a lot more heavy duty for modeling. So this guy has 2 books out there. This one's actually in a 3rd edition now.
What is the name, Professor?
It's called The Principles of Finance with Excel, and it's written by a guy named Simon Beninga. You can find it on Amazon, but there's a 3rd version which is co-written with somebody else. So somebody else has kind of taken the book over, okay? But it's not that expensive, and I at least once a year go back and look for this stuff. Now, for Excel, you can also, you know, best tool for Excel is go to the Microsoft Help Desk, you know, go to the Help tool inside the program, or go to YouTube and look, not Google, go to YouTube in particular. There's a bunch of weird people out there that, like, you know, film themselves doing different stuff. But that's the easiest way to learn, you know? You say, oh, God, I forgot how to do a data table. Boom, you know? You go, okay? So, anyway, but that's a book that and he has, like, an accounting primer that came with this. I think I've got it. So if any of you want it, send me an email and I'll send it to you.
What is that exactly?
Not the book. It's a PDF I'm going to send you. I'm going to send you the book for free.
You said accounting primer. What is that?
It's like 40 or 50 pages of basic, you know, accounting. I'm going to go through some of this now, but the more you read, the better off you're going to be. Okay. Now, I'm going to give you a few minutes, close to an hour, maybe not that much, of basic accounting. You can't do this in an hour, okay? But I'm going to try to, you know, kind of work through this. So, where does accounting come from? So, accounting is historical. Accounting, as we said, is creating the history, right? Writing the financial history of a company. So, it's a historical process, right? Why do we want to look at history? Why do we want to benchmark, right? We want to benchmark for 3 reasons in life, typically. You know, and the first one plays into accounting. We want to benchmark where we are compared to where we were. So we got to know where we were, right? We want to benchmark, obviously, versus our expectations. So, accounting, finance, and then more from an investigation perspective, we want to benchmark versus our peers. Because we want to know how we're doing compared to other people that do the same thing. We always think we're better than everybody else, but the reality is there's a lot of other people. We're a very deep country, a bunch of construction companies here, right? Does Moss do it better than Suffolk, you know? Does Miller do it better, you know? And so, or how do they do it? What kind of margins are they achieving, right? What kind of revenues do they have, etc., you know? So historically, we want to know where we've been. And so we've got to accumulate data. In particular, what we use today comes back from the Venetian traders. So, you know, Renaissance, right? Columbus comes to America, you know, people started going to the Far East. Why did Columbus come to America?
Trying to go to India, or trying to go to,
He was trying to go to the Indies, and he thought that there was a short way around, right? I'm gonna tell you a little story in a second, because it's kind of interesting. It has nothing to do with, it has to do with human perseverance. It doesn't have to do with accounting. But so the Venetians, right, became big traders, big merchants, right? So once they figured out that there was a route to the east the other way, the Venetians became the big traders. And so, you know, they're sending people out with goods, people are coming back with other goods. You had to keep track of all this stuff, right? Banking kind of comes out. The Medicis come out of Italy, so modern day banking kind of comes out of, you know, the Renaissance. These people were thinkers. So there's a guy named Fry. I used to ask this question in the quiz. There was a monk named Luca Paciolo who came up with this double entry system of accounting, which is what's used throughout the world today. So what we use today goes back to the Renaissance, okay? And basically, as I said, it's an algebraic equation, and he basically said assets equal liabilities plus equity, and said it a different way when he talks about debits and credits, or when we talk about a double-sided system, we talk about for every debit, there must be a credit, okay? There must be a balance. So when we make journal entries need a balance. Our algebraic formula has to balance. Our assets have to equal our liabilities plus equity, okay? So that's basically what, yeah, so the thing that just came to mind, just kind of, about this time, there was a guy in Spain in the late 1400s or 1500s named Ignatius of Loyola. He founded an order called the Jesuits. And, you know, they spread, created, you know, a bunch of universities throughout the world, and they became big missionaries. So, you know, well, what do missionaries do? They go places, right? You go and so they wanted, so they heard there was, so they're sitting here, people, I don't know how to draw Europe, England, yeah, I don't know, Italy, Greece, whatever. So these guys are sitting, and America's over here, right? And China's over here. And these guys wanted to go to China. And so all these people are kind of going down through South Africa, right? And it's a really long way around. And so I was reading a book. There was a guy who studied at Florida when I was there, who had a huge career at J.P. Morgan, and now he's retired, and he writes books for a living. And one of the books was how he was a Jesuit, how his training as a Jesuit helped him in the business world. And so he told all these stories about, you know, Jesuits. And so some guys got the idea that it was shorter to go overland rather than go all the way around. So, like five Jesuits set out. And, you know, Mongols, you know, all these crazy tribes, harsh weather, huge mountains. Everybody starts dying off. There was only one guy left. And now he knew he was getting close. Okay? Because, you know, you start talking to people, yeah, you know. So he knew he was getting close, but he was still a good year away, and he's in ill health. He made it a point to write down what his experience has been, and gave it, entrusted it to somebody, and said, you got to get there. And sure enough, the guy died, but his place in history is I got there. And basically the message was, don't take the overland route, it doesn't work. Okay? But the guy understood his purpose in life. He knew what he had to do, and he knew the importance, you know, of it for general, you know, we have satellites and all that now. These guys didn't have that, right? And so it all relayed on people's ability to write stuff down. So, you know, we have computers and all that kind of stuff. Anyway, it has nothing to do with that, it's just perseverance, okay? And knowing what your place is in life and in history, okay? So anyway, forget that. So, basic algebraic equation, for every debit there must be a credit, right? We ultimately, and I'll come back to how it happens in a second, but we ultimately want to create financial statements. So financial statements, really, there are two basic financial statements, but in a complete set of financial statements, I'm going to give you 5 different components that exist that are all important for you to know, okay? The 2 basic financial statements that we focus on in life is, one is called a balance sheet, and one is called an income statement or a profit and loss statement, okay? And if you think for a second, there's one distinct difference between the two. A balance sheet is a statement of financial condition as of a particular date. So it's like a picture. At December 31, your financial statement, your financial condition was that. Click. So it is who you are or what you look like, right? What your assets and liabilities and equity are at a particular given point in time, as of a particular date. An income statement or a statement of profit and loss is like a movie. And it tells you what your operations and what your expenses have been, and hence your results of operations during a period of time. So typically we would look for the period ending or for the year ending, right? So, whereas a balance sheet would be as of
Today.
typically the end of the period, the income statement gives us the history leading up to that date. So this allows us to measure the efficiency and the operation of a business. This statement allows us to see its financial condition. Yeah? Make sense? You're going to see, I'm going to show you my suggested solutions to the case study in a second, but if we kind of build that up, we're sticky people. We like format, we like structure, okay? And so, a balance sheet has a very specific heading. It has a company name. It has a description of the statement, and it has a date which it covers.
December 31st.
Okay? When you do a spreadsheet, your spreadsheet should follow similar nomenclature. By the way, when you send a spreadsheet to an instructor, just like you would send it to your boss, where do you leave your spreadsheet? Do you leave it in cell A1 maybe? Or do you just leave it like at the bottom of the spreadsheet? I mean, what do you want the person to look at?
At the bottom.
You want them to look at the bottom? No, you leave it where you want the guy to look at it, right? Or the girl to look at it, right? But when you go to the top, you want that spreadsheet. Somebody opens it, oh wow, this is that company, it's a balance sheet, and it's for this period. Any analysis, any spreadsheet, any report that we submit, okay? But important, as of. What does an income statement say? It's got a company name, right?
For the period.
And I grew up calling them P&L, statement of profit and loss, okay?
For the period ending.
You can call it an income statement, some people call it statement of operations. They're all indistinct, okay? And it's for the year or for the period. And why do you say that? Because now you know what you're reading. Now a reader, so it's, you got plans, you got all these symbols. I don't know what these symbols mean, but they mean something to you, right? These are the symbols that we use to tell us what we're looking at, okay? Now, in a complete set of financial statements, in addition to that, I'm going to say, in my world, in my realm, there are 5 components, okay? There's going to be either a cover letter or an opinion, okay? And, okay? So, if it's a management prepared report that you're just sending to the bank, you're going to have some sort of description of what you're attaching, the period you're attaching it for. Dear Mr. Lender, as required under our loan agreement, we're submitting a copy of our monthly financial statements for your review. Right? If it's an audited set of financial statements, it's a letter from the auditor saying, we have been engaged by this firm, we have reviewed the financial statements, they are properly prepared, they're prepared, in accordance with generally accepted accounting principles, consistently applied, okay, in our opinion, So you're going to have some sort of intro, cover, or opinion. You're going to have, in this order, almost all the time, a balance sheet. you're gonna have an income statement. I'm not gonna cover this in this class at all. Accountants do something called the statement of cash flows. I'm not gonna go over that in this class, okay? Basically, it is a statement that reconciles ultimately cash. Opening cash at the beginning of the year, all the changes in the balance sheet accounts, the result of operation, and it gets to ending cash. I'm not going to cover that here, but the statement of cash flows. And the fifth, and potentially at times the most important set of financial statements are the footnotes. And as I said before, if you don't read the footnotes of WeWork, you don't know that the owner has related party transactions with the company. Now, whether they are arm's length or not, related party transactions need to be disclosed. Details of equity structures, detail of debt instruments, commitments, contingencies, subsequent events, a detail of fixed assets. All this information. And we'll go through that. You're going to go through a set of financial statements this week of a home builder, and you're going to get a sense of, but footnotes, we used to put out, the language we used to use when I worked at Price Waterhouse was, at the bottom of every one of these statements, say the accompanying notes form an integral component of these financial statements. So we made it a point to, at the bottom of this page, let the reader know that without reading the footnotes, this was incomplete. So for you to get a true picture of a company's financial statement, or financial condition and results of operations, you need to look at the totality of these things. You need to see what the auditor is saying. You need to evaluate the face of the balance sheet. You need to take a look at the results of operations. You need to understand their cash flows. Okay? I think this is less important in the context of this program. And definitely you need to look at the footnotes. Because the footnotes typically, it's one of two things. It's information that management thinks is important for the reader to know, or it's information that the regulatory bodies have said you must disclose to your shareholders or your readers in order for them to truly understand what these numbers and balances mean. So, for example, we have something called PP&E. What's PP&E? Property, plant, and equipment, or plant, property, and equipment, fixed assets, right? We have something called depreciation. So, we don't put on the face of the balance sheet the useful lives. We might just put PP&E. But then on the footnotes, we're going to put so much automotive equipment, so much land, so much buildings, so much improvements. What's the useful life? What's the method under which we're depreciating it or amortizing it? Okay? So all that information rolls up. We may have something called, we'll talk about this in greater, we have capital leases. Okay? And so in the footnote, I'm going to say, okay, we're committed or obliged under the following obligations. And those obligations are in this time structure. We have debt. How do we repay debt? We don't put that on the balance sheet. But in the footnotes, we have to disclose the interest rate, the terms, the guarantees of any, right? And the periods of repayment. Okay? So there's a lot of information that essentially the footnotes give us to complement or support what's there. How does this work? We'll go over the case study so you can see how I would do it. So how does accounting work now? Accounting's real easy. You get a program at a very simple form. You get like QuickBooks. Who uses QuickBooks here? Only one person.
I've used it.
Yeah, I used to use another program. I got QuickBooks because I do the accounting for like 3 or 4 things. Oh, I had a student do the case study in QuickBooks once. Oh. I was like, wow, that's pretty cool. You know what I mean? So now it's all done in computers. But when I was young, we used to do it by hand. So accounting was done by hand. At a very basic level, you have something called the general journal. Okay, and in that general journal, you make journal entries. So, in the case of the case study that we're going to look at right now, somebody contributes $1,000 in exchange for $1,000 worth of common stock. You debit cash, 1,000. you credit shareholders' equity 1,000, and you put a description, you know, to record, you know, the subscription of equity by whatever, Banachi or whatever the guy's name was, okay? All right? And then you go to the second one, and so on. So at a basic level, you would do that. That's kind of what you're doing when you're inputting stuff into QuickBooks, or you're using Oracle Financials, or SAP, or whatever other company you're using, Yardi in the real estate industry, whatever it is that you're using. You're making journal entries. So for every transaction or event that happens, you record it in the history. You have to accumulate it later on. Now, this is kind of cumbersome in a manual role. So as a shortcut, we used to create, so we always had a general journal where things didn't fit in. But historically, somewhere along the way, people created something called the cash receipts journal, something called the cash disbursements journal, something called the purchases journal, and something called a sales journal. Okay? And that's kind of, I grew up working in my dad's accounting firm. We had 4 journals. Manual, we had like these 24-column sheets of paper. We would use pencil, because you'd have to erase, okay? And basically what we would do would be, so, and basically you're breaking up the 4 most common functions, okay, of what's happening. So, cash disbursement, all your checks. Cash receipts, all your collections, right? Purchases, everything you're buying, right, on account. Sales, everything you're selling on account. So, by default, what went into a cash disbursement journal were all credits to cash. Okay, so we would put like date, payee, amount, and then we would have 24 columns worth of, you know, expenses. So it could be payroll, it could be materials, it could be inventory, you know, it could be gardening, you know, landscaping, it could be utilities, whatever. So, you know, on 1A, we paid Florida Power and Light $100, and it was utilities, right? So that's like journal entry number 1. Journal entry number 2 would be on the 10th, I paid Southern Bell. I don't think it's called that anymore, is it?
No.
We paid them $100 for utilities. Or we could put telephone and telex, or telegraph, or whatever, you know, whatever used to exist in the day, okay? And so then at the bottom, at the end of the month, you would just total, okay, what you had. This gets transferred, and the easiest way to do that, you probably heard T accounts. Have you guys heard of T accounts? You've never heard of T accounts? Yeah. So T account, I'll show you how that works. A T account is a way to accumulate all these entries, so that you could get to a summation of all the entries during a particular period, right? So the way a T account would work would be like this. So you'd have like a T account for, let me erase here. Now the computers do all this stuff internally now, okay? You would have like a T account for cash, right? So here we know we got $1,000. So you do that. Here we know we paid $200, right? And then we would have one for utilities, right? We know there's $200, right? Okay? And then we got one for shareholders' equity, right? And we got $1,000. Those are the only entries that we have this month, right? I mean, that I posted. You're going to have hundreds or thousands or millions, depending on the scope of a company, right? So once you've accumulated these entries, you create a trial balance, which is kind of like a T account, but it's a summary of all of your accounts and the balances at the end of a particular period. Okay, so in this case, cash has a debit balance of how much? 800. So 800, right? Shareholders' equity has how much?
200.
1,000, right? And utilities has how much?
Utility 200.
200, right? So my trial balance has to balance, right?
1,000. 1,000.
Now imagine that with millions of entries in a day or in a month. That's why you need a computer. But now I've got a trial balance, right? Now I can make financial statements. Wow. Okay, so let me just erase this. Now I can make financial statements. I can make financial statements, right? So I can make a balance sheet. Can't I make a balance sheet?
Yes.
So my balance sheet, company name, balance sheet as of 12/31/X1, assets. Assets are how much? What assets do I have? Cash, right?
800.
How much cash do I have?
800.
Okay, I don't have anything else, right? Do I have any liabilities? No, those are expenses. We're not there yet, so do we have any liabilities? No. Okay, do we have any equity?
Yes.
Okay, how much equity do we have?
1,000.
So we have shareholders' equity, we have common stock that was issued of 1,000, right? Well, what else do we have?
We have
So we have what's called, when we close out the, so we have an income statement. So you can't finish your balance sheet until you do your income statement. We got company name. We have income statement, right, or profit and loss for year ended, right? Okay, do we have any sales? No. Do we have any expenses?
yes.
Okay, so we've got expenses of how much?
200.
200, right? So do we have a net loss of how much? 200. So the results of operations, profit or loss, always transfer to your balance sheet. Okay? So otherwise it doesn't balance. So included in equity, if you made money, your equity goes up. If you lost money,
Go down.
your equity goes down. So I just did a set of financial statements out of 3 transactions for a particular month. It's pretty simple, isn't it? You guys thought it was hard? You guys are like, no. No. Okay, does it make sense? Kinda? Kinda?
Yeah, I'm sure it does.
Yeah, no. So, yeah, you can't do this in an hour. But you can understand that from a formula and a concept that debits equal credits, you can record transactions in a way that allow you to summarize it and create financial statements. And now I could say, hey, this company's got $800 of cash. Hey, this company lost $200 during the month. It didn't sell anything. It has no liabilities. Notice all the different, interpretations that you could start making. Now, blow this up, it may have receivables, it may have payables, it may have tax obligations, okay? It may be in bankruptcy, it may have more liabilities than equity. So, when you start populating this with more transactions, now you can start analyzing it. But accounting is nothing more than recording transactions, accumulating them, and reporting them. Record transactions, accumulate, and report. That's it. That's all there is. I mean, there's no more. There's no more than that. I mean, I could do it again. I could make more journal entries, right? I could record sales here. I could create accounts receivable. I can create payables. I can create inventory. Okay? I can do all the other things that a company does. But ultimately, it's just about recording the history, accumulating it, and reporting it. Okay? Now, I don't want to confuse things too much, okay, but we'll go through the case study. In the case study, you're going to see that there are a bunch of different concepts. I'm not going to say that there were tricks in there, but there were a series of different concepts that we need to understand when we record transactions, right? So when do we record a transaction? So sometimes we incur an obligation, but we don't pay it at the time. Or we're entitled to something, but we haven't been paid yet. And so in the concept of accounting under GAAP, what we talked about as being GAAP the other day, we talk about what's called the accrual basis of accounting. So GAAP is predicated on what's called the accrual basis of accounting. Under the accrual basis of accounting, what's understood is that expenses are recorded when they are incurred. Alex, expenses are recorded when they are incurred, and revenues are recorded when they are earned. So, under the accrual basis of accounting, we record expenses when they are incurred, and we record revenues when they are earned. We do not record items when we pay them or when we collect them. So we ultimately go to when the service has been rendered, regardless of which side of the equation you're on, when the service has been rendered, when the obligation has been, or the rights have been created, that's when you record. Okay? Now, the accrual basis of accounting does not record transactions when they are paid or collected, but rather when the obligations or the rights are incurred. Okay? Or earned. Okay? So that's an important concept. Now, so that's GAAP. In GAAP, we're always in an accrual basis of accounting. Now, are there cash basis financial statements? Do some people prepare financial statements under a cash basis? Yes. Why? Well, some people aren't sophisticated. Some businesses are cash businesses. Okay, if you're a grocery store, you know, you pay the rack jobber when he comes and drops out chips, and when you buy them, you know, you get, you know, somebody buys them, you get paid. In the context of real estate, a lot of institutional real estate investors are pension funds that are non-tax paying entities. So they don't care about accrual basis of accounting. So they report on a cash basis. You have people, and even the tax code allows you to report under what they call a modified cash basis of accounting. Okay, and to some extent, tax basis is kind of modified. Tax basis is going to be kind of like you record revenues when you collect them, and you record expenses when you pay them. They kind of put you against the wall, you know. So they're going to anticipate any cash that you get, they're going to tax, and you're not going to get a deduction until you actually pay it. Okay, so there's different bases of accounting out there. There's something known as the liquidation basis of accounting. If you're in bankruptcy, if you know you're getting rid of certain assets, you must write them down to liquidation value, what you think you're going to realize. But GAAP as a whole is recorded under the accrual basis of accounting. And in the accrual basis of accounting, you record expenses when they're incurred and revenues when they are earned. Okay? There's a bunch of regulatory agencies. I'm going to cover where we're at with that today. There are a lot of different influences that tell us what GAAP is. I'll cover that after the break. Okay? Why do we use financial statements? What are financial statements used for? What are the basic uses that we have for them? So we report to our shareholders. We report to our lenders, right? Sometimes we report to our employees. How many employees don't have some sort of incentive-based pay? So they want to know how much goes into my pocket, right? Sometimes we have to report to regulatory agencies, right? If you're a public utility, you got to report your financial statements to the regulatory agency so they can authorize the rates that you can charge, right? So there's a lot of different stakeholders regulators, shareholders, creditors that look at financial statements. So to the extent that we can understand not only how they're accumulated and reported, but the basis under which, and that's what we're going to spend a few, well, probably one session on. I spent more on it, but one session is understanding the nuances of real estate accounting that impact financial statements of real estate companies, whether they're developers, home builders, or just owners, okay? Just a couple of other concepts that I'm going to throw, and we'll take a break. There is something that we call internal controls. Internal controls are processes that companies put in place to safeguard assets, okay? And again, I used to spend a little bit more time on that. It's really important. So, for example, simple things like checks require dual signatures. You essentially would force two people to be in cahoots in order to steal money. Other segregations of duties, like the person that opens the mail is not the person that deposits the checks, is not the person that has the authorization on signatures. The person who pays an invoice is not the person that receives the goods or ordered them. Okay, so they are processes that companies put in place essentially to safeguard their assets, in a lot of cases money. Okay, management is responsible for those controls. Now, big companies, a lot of companies, but bigger companies and companies that have debt typically are required to be audited by a third party. So I'm not going to spend a lot of time on this. Auditors are people that come in and express an opinion on the fairness of the financial statements. They don't check for fraud. They don't look for theft. They specifically issue an opinion on the fairness of the financial statements, prepared in accordance with GAAP, consistently applied. Okay, so there's a big difference between what auditors really do and what the public thinks auditors do. Auditors come in, understand a company's system of internal controls, okay, which safeguard their assets, and do techniques to issue an opinion on the fairness of the financial statements. So they don't give you an absolute, hey, these things are perfect. They say, hey, based on what we did, nothing came, well, that's negative assurance. We believe they're fairly stated, in our opinion. Okay, so it's a third party that comes in and at least provides a certain level of review over the financial statement. So bigger audit firms implicitly are going to give you a better sense of comfort. Firms who you don't recognize may actually do very good work, but maybe they don't. Okay, and so you just need to know, if you're not at a big national or international firm, when you're looking at an audit. So, you'd say if you're looking at a publicly traded company and they're audited by a local firm, that's a big, antenna right away. Now, maybe it's good work that's been done, but maybe not. So, the concept behind there is if you're Deloitte, you have a lot more to lose by not doing a good job than the local guy that maybe is getting, paid off. Okay, so, but I don't want to get into all that. We'll talk about taxation another day. So taxation is a whole other realm that has nothing to do. So how you accumulate the information to prepare your tax return and report on tax forms has nothing to do with GAAP or financial statements. That's a whole other realm. We'll talk about that another day. There's a whole other body of knowledge within accounting, which is called managerial or cost accounting. It's very relevant in our industry. It's relevant in construction, it's relevant in development, it's relevant in services. If you're an architect and you have a good internal cost accounting system, how do you bill? How do you know how much money you made on a project? Same thing in planning. Construction company, right? Especially when you're doing cost plus arrangements, right? So cost accounting or managerial accounting is a subset, okay, of overall accounting. We typically manage that through different journals, okay? Different journals that we're going to have. We're going to do a case study at the very end of class. We're going to sort of cover that, but very detail oriented, very, very difficult to follow, but very important in the industry in which, you know, we're in, okay? We already talked about this. So historical accounting deals with, or accounting deals more with historical, finance is more prospective. So when we talk about budgeting and modeling, we're probably more in a financial realm, where we're looking at prospective, right? Ex ante data, things that we are anticipating before the fact. Accounting is much more historical, okay? And so we're looking at ex post data. Things happened, and now we're recording them, okay? There's certainty here, there's uncertainty here. Now, that said, there are concerns related to valuations and the use of estimates that come into play with some historical things. We know we have receivables of $1 million, but are they collectible? We'll spend a little bit of time on that. So, do we have to reserve for that? Are we going to collect every penny? We know we have inventories, but are they obsolete? Or has the market gone south? I'm Lennar. I have a bunch of land inventory. It's 2007. Is it worth what I paid for it? Is the asset worth $1 billion, or is it worth $600 million? And how do I report it? So in accounting, valuations and the use of estimates become very critical in how financial statements are put together. And that's why we need to take a look at footnotes. And that's why we need auditors to come in and take a look at what management has done in that way to opine on whether they follow the techniques. We are going to take a 10-minute break. We'll be back at 10:30, and we're going to keep going with this. Hey, I'm wiped out when we're done, but I know you guys are too. But...
Yeah, but we're only halfway done.
Oh!
Headed back to the
Ben says hello again. He's getting married this weekend.
Is it this weekend?
Yeah, he's in Puerto Rico right now.
Oh, it's like a destination wedding.
His wife's Puerto Rico.
Oh, okay, so it's not a destination.
It kind of is beside.
Okay, well, good. And then he's going to be off for a few weeks, or?
Yeah, he's going to somewhere in Greece for a week and a half.
I sent you an email.
And they're straight
Send me
away,
your
right?
number so we can like.
Yeah.
do
Oh,
the
you
thing.
did it.
Yeah, it's like my nephew
Already?
got
I sent you
married
mine
March
already,
1st,
so
so
just give me
it
your
was
number
busy.
so I can put it there.
I got married March 9th.
Oh, yeah, he's.
Just March 9th.
That's one.
Who's our court?
He's sitting right next to you.
Oh.
So you, same thing, you didn't, well, that's the thing,
Yeah.
my nephew's
Yeah, I
like,
didn't know.
next week for 3 weeks. So they had to-
Quick back to the office. Oh, married. All right, bye.
Sitting next to you, right?
And are you gonna do a honeymoon at some point?
Or should I say
What group are you? Are you-
I've been renting a rent for a while, so it's
I'm with Kyle.
We want to stay.
Where are you at now?
We're looking for my parents' house in Harbor Beach.
Okay.
What kind of project is that?
Well, that's the best place to
Multifamily?
say-
I know, it's not bad.
I know, but you don't wanna be there too long.
No,
I didn't look at it yet.
so
You know,
we just signed a lease last weekend in
But I know
Essex
who I
Tower
wanna
in
be in,
Los
that's
Angeles.
fair.
Okay, I don't know which one.
It's
Important
it's
to
an
say.
old tower. It's
Downtown.
an old tower right by the Los Angeles Bridge. Awesome, 2-bedroom. It's awesome.
It's awesome, no.
Yeah.
No, listen,
So we're renting for a couple of
look,
weeks.
I've been at my parents' house and I've been to it, I mean, you could really say,
We did. We
but when you're married.
Oh, we're out now. We just got
Yeah,
married.
it's, you know, you can't do that too long, you
No,
know.
they left. My parents were already up in Long Island. They both Long Island.
So they go up there for the summer?
Yeah, for 5 months. It's great. So we have the house for ourselves.
Well,
So they
that,
come
that- well,
back.
that, you can wait in
Yeah.
5 months.
So I was saying we're leaving. They come back in September. We're leaving in August. That's when the lease was signed. So.
So they're not in New York long enough to be New York residents.
Correct. They're retired. I mean,
It's funny, there's a guy that I didn't see him this year at all. He was a bond trader, and he and a buddy of his, actually a guy from the horses, bought a place.
My dog was a Japanese.
These two guys bought a place in Key Biscayne like in the early 80s. And, they would come down, they'd use it sporadically, sometimes they coincide. One was from DC, one was from Long Island. They eventually both got married to the other guy, so that the other guy bought a place. He died. But this buddy of mine, you know, he goes back to Long Island, but, and I don't know, so he moved, so I didn't see him this year, because he moved up to Bay Harbor Island, so he was always in Indian Creek and stuff. But his big fight was, I don't wanna be a New York resident anymore, but he doesn't wanna be here long now. And because his wife, you know, he's got a daughter and a grandkid, and the wife wants to stay up there, and he can't be alone, but it's money. I mean, it's like real money, it's not BS money, it's real money.
You want a coffee or anything?
No, I'm good, thank you. I'm gonna make a pit stop. I know it's a lot of material to get off
I second that.
Professor just asked him, is this too much? And he's like,
What did you
no,
say?
it's good.
Oh, yeah.
You can hear me say it. I'll say it to the screen.
How do you sell your insurance? Over the phone, I guess?
I don't sell it.
You don't sell it?
Yeah.
You just make appointments with it?
No, it's adjusting.
Oh.
Yeah.
So you go out there and see who ripped off what?
No, those are different people. I literally just sit behind a desk. Honestly, it's not that good. It doesn't keep me water cold.
Doesn't, everyone has one.
I used to have a really good one.
The
and I got
stocking
it
stuffer
from-
last year.
Huh?
It was a stocking stuffer last year.
It's just like Target and then it's pretty brand.
This one is really good.
That's the hydro flask?
Thermal flask. Like I put overnight good, like 2 days good.
Really? 2 days?
I heard
You
that
keep
those are
coffee
good.
hot for 2 days?
Well, I don't know, I
Or-
drink water and it only do
Yeah.
cold stuff.
I heard that was really good. That's the one I wanted to get, but I needed a water bottle because we were doing the construction for Habitat for Humanity. So then I wanted to go out.
Oh, you got a habitat.
Yeah.
We're out there.
I was like, I'm gonna die. I know how thirsty I get.
They had water there. Woody didn't have no, like beer
Yeah,
for y'all or
He
anything?
didn't have no beer, I wish.
I saw a picture. How was the site? Did you go?
Yeah, it was good.
It was probably good because Woody didn't touch it.
Yeah.
I'm sure he put a lot of.
It was, yeah, it was good. We actually ended up doing 2 buildings, 2 houses.
Hammering.
Man, we
Did you
had
go
a
to the
good.
first one that we
Like,
went
it's
to
only
the
been
construction person?
Marcella went on that one, I think.
Yeah, we did.
Yeah.
If you know
A nail gun? They
But it
give
was
a nail
given
gun?
by,
That's
No, no, no,
dangerous.
no.
yeah, driven from one of their
Was it?
projects.
No, it's not like a drill.
It was okay. It was more or less supposed to learn about what they did.
Oh, you guys didn't actually do
I love
work?
that shit.
Like, they had us working.
Oh, why
We
would you
did
do
work.
that?
We were working,
I just think where
That's strange.
yeah. And we were
I
putting
didn't know this
up,
was like carpentry construction skills.
and that's what it was.
That's strange.
It was fun. I said
What
every
if one of
class
y'all
should
would've got
have
hurt?
been. Well, we had to sign a
Well, that's
waiver. We
insurance.
signed a
Oh, you
waiver.
signed a waiver.
Doesn't
Yeah.
say, right? It's not gonna be like.
Come on, no, liability was the first thing they thought of.
Oh, of course.
Yeah, no, we all had to sign a waiver. But, yeah, it was good.
So what is it, what did you actually labor on?
We were doing the ceiling. Like they just put up rafters
So
and we
you
were,
hanging the ceiling,
no,
plastering?
we were doing the stuff that you put the drywall onto.
Yeah, the
I had-
So you
The
have
plaster.
to.
We didn't do the drywall, we just put
Just
the,
got it on the wall.
no, we put those metal strips that they attach the drywall
And
to.
did you time?
I
Is
had-
this, is
Oh,
this,
okay.
Did you time?
were you doing like one of these home building things?
We went to, we did a Habitat for Humanity.
Oh, that's what, yeah, Habitat, that's,
It was fun.
who did you do that with?
Woody,
Woody, okay, so I was gonna say, Woody.
In Pompano.
I thought they gave
Not now.
me
Is it one of those where.
That's something to do, like,
They bought out the whole street, and they were developing like the whole, or they were developing several at once.
Yeah, they were developing several at once. I think they have like maybe 10 houses up now.
Kind of a rough area.
Yeah, it's a company. It's like, you know,
So we got the land.
where are we? Where are we? I don't know.
I need to know what I
The neighborhood says that they're
They helped me because I
Oh,
was
sure.
doing it. Made
I
things
took
easier.
video of the site.
But it should give you an idea of how you have to be.
I was like, how are you gonna get over there from underneath? There's no way.
Well, first, yeah, no.
What's up?
Like, another thing, like, the Wall Street Journal just did that, like, they offer, like, different rests.
Did I send you? We're trying to catch up on
Class. Time to go. All right, so we're talking about gap, right? So ultimately, no, not gap insurance, and not mind the gap, but gap as in generally accepted accounting principles. So you know, in as much as it's important to know how we record data, accumulate it, and report it, it's also important to know the guidelines that we use in understanding how to record it, or how to accumulate it, how to report it. And that's this whole thing, that this sort of nebulous concept that we call GAAP. Generally accepted accounting principles. Now, is there a book that says, here's the GAAP book, read it? There is not a book out there that's called GAAP. There is not. So maybe, so I can tell you definitely, I mean, there was an attempt, a lot of countries would try to regulate on their financial reporting, right? And so, like I remember when I worked in Spain in the late 80s, statutory accounting in Spain was really required to follow a tax code. So if you were the equivalent of a CPA, if you were a Censor Juzgado in Spain at the time, you would issue reports on what were essentially statutory financial statements. And the government kind of said, you will report financial statements in accordance with the tax code. Well, it may not have been accrual basis accounting, it may not have been, quote, accurate, but at least you understood what the tax code was. You at least understood what those financial statements meant, how they were, they're comprised, right? So some people, now that's all changed. Spain joined the European Union. The European Union is kind of, so there was UK GAAP, which was actually very good. There was a, very good guidance here. But now, there's been this whole creation of, in this country, we have something called the FASB. What's the FASB? Kind of like the military, right? It's all acronyms for everything.
Yes.
So it's called the Financial Accounting Standards Board. The Financial Accounting Standards Board. And the Financial Accounting Standards Board, not to confuse, used to issue statements of financial accounting standards, but whatever. There's now something called IASB.
International account.
Yeah, the International Accounting Standards Board. And so there's been this push. This thing's headquartered in England, and the EU kind of put its bet on this thing. And so there is something called international GAAP. So it used to be like UK GAAP, Canadian GAAP, US GAAP, Japanese GAAP. There's definitely US GAAP now, and there's starting to be this sort of international GAAP, right? And so, you know, they're kind of behind the US, and there's been these attempts to kind of harmonize, you know, standards so that you kind of get this worldwide standard. We're not there yet, and we're probably not going to get there because there's some philosophical differences on how people on either side of the continent, you know, want to report things. And there are things that are inherently, so financial transactions and financial trends and techniques are not static, right? So, you know, for example, Venezuela, right?
Me?
Yeah?
No, man.
Oh, so dude, I thought you were assuming we had a Venezuelan here, what's happening in Venezuela? Forget the political issue. What's happening currency-wise in Venezuela? Huge hyperinflation. So when you've got huge hyperinflation, it's very difficult to report financial statements on a historical cost basis and have them make any sense. And one of the premises that we have in this country is that financial statements are always recorded based on historical cost. Historical cost. Okay? Now, what happens when you're in places where you've got runaway inflation all the time? Historical costs may not mean anything. And so we've got this, because we don't have that in this country, we don't really contemplate rising prices in that sense, right? But in other parts of the world they need to. So there's always going to be fundamental reasons why reporting in some countries is going to be different than reporting in others, okay? And so, but we didn't always have the FASB. So kind of modern accounting in this country starts, so I mean, we had accounting from Luca Paciolo, and, you know, the Italians gave it to us, right? The Renaissance gave us, you know, beautiful art and music and accounting. And notice how that just flowed, you know, just sort of flowed and accounting. And so, you know, people will do the record keeping and all, but as we became an industrialized society and we started, you know, having the formation of financial markets, so late 19th century, you started having the creation of these accounting firms. So Mr. Price and Mr. Waterhouse, you know, Mr. Haskins and Mr. Sells and Mr. Touche and Mr. Ross and Mr. Young and Mr. Arthur Young and Mr. Ernst, and all these people started creating these accounting firms. And so there started to be this sort of formalization of the accounting profession. And these accountants would help companies with their, you know, accounting, and then they became independent accountants and started, you know, the whole concept of auditing, you know, kind of came about, right? But still, up until the 1950s, we didn't have any sort of, in this country, didn't have any kind of sort of standardized guidance as to what GAAP was. So, you know, we had textbooks, we had business practices, but, you know, stuff all over the place. So in the 1950s, there was an attempt to do something called the Accounting Research Bulletins. And I think, if I'm not mistaken, ARB 51, and this is older than me, it's like 1958 or something like that. So under ARB 51, we kind of standardized all these historical business practices into GAAP. We kind of say, hey, this is how we consolidate, this is how, you know, we're an accrual-based system. So ARB 51 kind of says in the late 50s, hey, here's the first time that somebody puts in paper and says, hey, this is GAAP. So we went through a period of, the AICPA created something called the Accounting Principles Board. So the professional guild created something, the American Institute of Certified Public Accountants created the Accounting Principles Board, and they issued at least 30. I don't know where it stopped. So sometime up until the early 70s, they issued these pronouncements. Some of these pronouncements are still guidance today. We don't say under APB 18 we consolidate this way anymore, but that's the way it used to be. So, and then sometime in the early 1970s, not only the accountants, accountants can't regulate themselves, they can't create their own. So this Financial Accounting Standards Board was created by industry groups, academia, and the accounting profession as an independent, not-for-profit entity that would promulgate accounting guidance. So it kind of took over, and in fact, I've lost track. I don't know how many pronouncements these people issued, but they issued, so from the early 70s till 2010, they issued like, I want to say about 175 pronouncements. So I get lost with all this stuff. And some of these pronouncements were replacements for some of the previous pronouncements. Okay, and so, but then some of the pronouncements were like, so there's this, one of the things I used to teach in a capital markets class, it's the paradigm under which the financial world works and the legal world works, is we have this push-pull between innovation and regulation, right? And so what happens is innovation happens and then somebody regulates and says, you can't do that, right? Somebody, let's put it in the context of today. Somebody invents Facebook, right? Somebody invents Google. Somebody invents Twitter. Somebody invents Snapchat. And now people are starting to say, you can't work the way you're doing. You're not regulated. So somebody's going to come in at some point and either break them up or set guidelines. And then once those guidelines are set, what do you think is going to happen? A bunch of attorneys are going to get hired. A bunch of Wall Street guys are going to come together. And they're going to figure out a way to circumvent that regulation. We're going to call that innovation. Okay? Which is going to give rise to more regulation. There's always this push-pull happening, right? So I'll give you an example. I was in university. The FASB comes out with SFAS number 13, and it talks about leases. So you say, well, how do you record leases? What are leases? Why do you record them? How do you record them? Important in our industry, right? So they said you got to do this. So what did people come up with? They created something called a synthetic lease. And what was the purpose of creating a synthetic lease? It was to circumvent the regulations that were here. So that what the accounting people said, the way you should report so that a prudent reader of your financial statement understands your financial condition, that they would be able to circumvent it. Okay? I'll give you another one. There's a bunch of different APBs that dealt with consolidations, right? We've got ARB 51, APB 18, I think 30 deals with it. So we'll talk about principles of consolidation, which is important in real estate. How do I account for a 20% interest here, and a 50% interest here, and a 100% interest here? How do I show a reader what my financial condition really is, okay? But we've got guidance that tells us what to do. Well, so we have to include our assets and all of our liabilities on our financial statement so that the readers understand what the totality of our financial condition is. Well, you guys ever heard of a company called Enron?
Yes.
There was a movie called The Smartest Guys in the Room or something or other. So one of the innovations there was the creation of, well, I mean, they took advantage of it. They didn't create it, but they took advantage of something called the VIE, a variable interest entity. And so what's a variable interest entity? We may go into that in more detail, maybe not, but a variable interest entity is one that ultimately attempts to circumvent the requirements to consolidate a subsidiary. So it's an entity that looks like something, but it's really something else. So for example, Jeff Skilling, who was the CEO or the president, or Andy Fastow, or Andy Fastow was the CFO, Andy Fastow's wife would own an entity that would issue a bunch of debt. And that debt was guaranteed by Enron. But because it wasn't owned by Enron, so technically, it didn't have to be consolidated, but the spirit. So in accounting, we've always tried to talk about substance over form, right? If you are trying to do something, you're trying to create a different impression than what there is there, you're probably doing something wrong. Okay, so, but these guys use these variable interest entities and hit a bunch of debt and a bunch of losses, and they weren't reporting them. And then eventually somebody came in and said, look at all the shit that's here. And the thing blew up, okay? So then somebody's got to come and say, oh, well, these guys have created this, now we got to address it. So a lot of these additional, statements just deal with people changing their business practices. Now, in addition to that, you had like accounting intermediate, whatever, the AINs, I forget what that stands for. You had FINs, financial interpretation. So you had different bodies that would make interpretations of this. So at the end of the day, it all became a cluster. Because like, how do you know what guidance to follow? Do I get the old book of APBs? So when I started working in accounting, there was a book, okay? The Financial Accounting Standards would put a book together, and it had all the APBs, and it had all the FASBs, and then in gray they would put the areas that were superseded or had additional guidance, and then you had to go to another section to look for that. So in about 2010, they said, hey, we're getting rid of all this stuff. Now, I'm still not totally up to date on it. I still think in these terms, I'll still talk to you about FIN 46 that addresses variable interest entities. I'll talk about FASB 66, which deals with the real estate sales and stuff like that. I'll deal with, 13, although that's been superseded now as well. But they created something called, they came up with something called accounting codification, okay? So the FASB came up with accounting codification, and so it's something called ACS, accounting codification. Is it system or structure? I don't know what the hell it's called. ASC, I'm sorry. Accounting Standards Codification, okay? And so what they've kind of said is, hey look, and you don't need to know the detail of this stuff, but what they've done is they've kind of created a table of content. Now curiously, preparing for this, I actually went back, because I didn't study this in school. This has all happened, in a relative recent past. So they kind of said, hey, we're going to, not right or wrong, whoever did it this way. We're going to address general principles here. So that's the 100s. It's the index. So all the things that are 100, ASC 100 are general principles. ASC 200 is presentation of financial statements. Anything related to assets is going to be 300s. Anything related to liability is going to be 400. Anything related to equity is 500s. Anything related to expenses is 600. And then broad transactions, leases, business combinations, non-monetary exchanges, like-kind exchanges is going to be 800s. And then industry-specific guidance, airlines, contractors, the real estate industry, utilities, is going to have some line item in the 900s, okay? And so what the Accounting Standards Codification does is it historically took all the literature that was out there and broke it down into these little subgroups, okay? And now every time something new comes out, rather than knowing whether the financial, I forget what FIN stands for, interpretation, so financial interpretation number, so, whatever FIN, whatever, it already drops specifically into the bucket of knowledge that you want to know. So if the financial interpretation has to do with recording investments or valuation concerns related to inventory, it drops into the inventory bucket, okay? And so we don't need to know these numbers, but just so that you get a sense or an idea, things that impact real estate directly, okay? Now they may not only impact real estate, but real estate directly. So section 323, assets, 300. Section 323 deals with investments. So if we have an investment in a joint venture, whether we own an interest in, so we're going to look for guidance there on how we report that, right? 340 deals with PP&E, plant, property, and equipment. So to the extent we own assets, we own buildings, we own land, they're going to want to take a look at what it tells us on how to record it, how to depreciate it, how to value it, etc. To the extent that we're a dealer, most developers, unless you're home builders, inventory, so your real estate is not inventory. If you're a home builder, your real estate is likely inventory because you're a merchant builder. Probably more of a tax concept, but it's also a concept for financial reporting purposes. If I'm Lennar, I'm building widgets. They happen to be houses, but I'm buying big pieces of land and I got an assembly line kicking houses out. Okay? If I'm a REIT, I'm buying buildings and I'm holding those buildings. That's not inventory. That's a fixed asset. Okay? So inventory are items in which you're a merchant, in which you buy or manufacture for the purpose of selling. Okay? A fixed asset is something that you have to hold long term to generate income out of. Okay? So but to the extent we're a home builder, we need to be concerned with 330, which is inventory. Okay? Now, on the debt side, there's not that much that's unique to real estate. Definitely 605, revenue recognition. Do we have a sale? I mean, so we sell something, but we took paper back, so we took a mortgage back. Is that a sale? Well, I mean, so there's guidance that tells you if it is or not, you know? There's things you need to take a look at to determine whether it's a sale or not. And if it is a sale, how do you recognize a profit? Because there's different ways of recognizing profit, okay? Do you recognize all of it? Do you recognize it on an installment basis? Okay, there's different ways to do that. 805 and 810, which are already broad transactions, so business combinations and consolidations. So that kind of ties with 340, okay? I'm sorry, with 320, which dealt with investments, okay? 820, which is fair value, that kind of ties with inventory, with 330 and 340. So has there been an impairment of value, okay? 835, which is interest. I'll talk about that in greater detail. Construction period interest. Leases, big way of financing transactions in real estate, okay? Non-monetary transactions, like-kind exchanges. Those are all in the 800s. Construction companies, which we don't really, we'll talk a little bit about construction companies later on. I don't really get into construction company accounting or financial reporting, but those of you who work in the construction industry, there's a whole sort of, how do we record revenue under long-term contracts and things like that. So there are nuances related to construction companies. And then all the way down in 900, from 970 all the way essentially to 980, we're dealing with real estate companies. So just general real estate concepts, common interest realty associations, condominiums, co-ops, things like that. 974 is REITs, anything related to REITs. So there's not a lot of REITs, but they hold a lot of value. So it's important to have guidance for them. And then two things that are critical, I'll mention in a couple of classes some stuff about it, which are of key interest in Florida, although probably less so now. Retail land companies and timeshare activities. So just there are certain things that definitely have a uniqueness in the accounting realm as it relates to real estate companies.
Excuse me.
Yes, ma'am.
Those were all the codes you gave were codes you would find for the accounting standards codification?
Yeah. So
sections of.
So if you go, so the FASB, the Financial Accounting Standards Board, has a website. It's called asc.fasb.org. You can go and sign up and get access to these if you want for free. Now there's a premium version. I don't have that, but you can sign up, and once a year they'll send you a reminder email. And if you have a question on how do you deal with impairment of values, you can go and look. I don't need to do that. That's for an accountant to do. That's for your accountant to do. But so you don't need to know that. But I think that what's important, there's 3 or 4 areas where there are either key differences or specific interest in real estate entities that we need to look at accounting guidance. Okay. And the first broad one I'm going to deal with is what's called development costs. Okay. And under development costs, there is because we tend to borrow a lot. Construction period interest is one of those costs, okay? And those are dealt with separately. They all sort of fold in together, okay? But, so, we talk about, so, in previous class, when I used to teach this class, I would tell you that that was covered by FASB 34 and FASB 67. I'm not going to tell you any of that stuff. I'm not going to tell you that it's covered under ASC 330 or 340. But what is important to know is that anytime you're accounting for your development costs, including construction period interest, you need to look at the specific guidance, because there is guidance that is geared towards our industry, and we need to understand what that is so we understand how it is that we report it. Okay? Sort of next broad area that I will tell you that there's specific guidance that we need to is leases. Okay? Now, in a previous statement, I said that this was originally FASB 13. Well, so what happened is there was a new accounting statement that was issued in 2016, number 2 in particular, which superseded this. So there's now new guidance on how you record leases. We'll talk briefly about that, okay? So this was all thrown out, but leases, because most transactions in real estate, or a lot of transactions, are leases, okay? And it's really just a form of financing for people, okay? So we need to understand the guidance there. And then the other one that I would tell you, we're in a transition period there, so I'm not going to get into all the nuances of revenue recognition, okay? So we need, of key concern and interest, and we'll go into it into greater detail in the next class, are development costs, including construction period interest, leases, and revenue recognition. Okay? Do we have a sale? Do we recognize profit? And when do we recognize profit? Okay? So those are key areas. Now, additional areas of interest for us. Okay, additional areas of interest for us, and I'm really just repeating what I just said a second ago, is anything related to consolidations. Okay. Okay, or reporting our investments in subsidiaries is critical for us. So this is not unique to the real estate industry, but because it's a capital-intensive industry and we try to form a lot of joint ventures, bring financial partners in, we tend to do a lot of combinations, and so we need to understand how to account for those things, okay? Because we're subject to market cycles, right? We need to take a look at what's called impairment of value, or fair value. Okay? So, there's an old historical accounting sort of realm that we state our inventory at the lower of cost or market. So one of the basic underlying principles of accounting is that we're conservatism. So we're going to state our inventories at the lower of cost or market. That means if we build this book and it costs $1 and we could sell it for $2, but it cost me $1, I'm going to record it at $1. If the book cost me $1, but I can only sell it for 50 cents, what am I going to record it at?
Loss of $1.
Well, I'm going to record it at $1, and I'm going to create a valuation reserve that not only accounts for that decrease, but also the cost to sell it. So if it costs me 3 cents commission to sell it, or 3 cents of interest to hold it until I can sell it, I'm going to create a valuation reserve against it. So additional interest for us is impairment of value, okay? And then I would say, because we do see a fair amount of non-monetary transactions, okay, like-kind exchanges, okay? And there is guidance on how to report. So we've got guidance in the tax realm under 1031, how to account for like-kind exchanges, whether they're true like-kind or there's food exchanged, okay? But we've also got financial reporting guidance on how to deal with non-monetary transactions, okay? Let's see if there's any other ones that I think are... one last one, which I think is important. especially in the development realm, and that's commitments and contingencies. What are commitments and contingencies? What do they sound like? Well, they may relate to contracts. So commitments would be, a commitment would be you're a party to a contract in which you have an obligation to do something. So you may have an obligation to deliver something, but you may have an obligation to buy something. For example, I remember we entered into these take-or-pay arrangements back in 2005, 2006. Very difficult to get rock, structural fill, and so we entered into a bunch of forward contracts with miners where we agreed to take X amount of material, and we had to pay for it regardless. Okay. So from our perspective, we needed to disclose that so people knew that we had an obligation to buy something, a minimum amount at a fixed rate, but from the miner's perspective, they also had an obligation to report that they had a commitment to sell X amount of rock at X amount of, at X price. Okay, so for them it was a commitment on the revenue side, for us it was on the expense side. Okay, those are things that typically get disclosed in footnotes, not on the face of statements. Okay, what are contingencies?
Situation that can cause
something that's contingent.
Contingent,
Okay?
yeah.
So something that could become or not. So give me what's a potential contingency in the context of financial reporting? I have a lawsuit pending. Somebody sued me. So I may be liable. I may not be. Okay? Let's look at it more. So that happens all the time in property management, man. Like all you get, everybody slips and falls, especially if you got a retail property. You have multifamily, right?
Yeah, so that's happened before, right?
People slip and fall all the time on your property.
And
And nobody ever sees them.
Yeah, and then people do it on purpose. There's people that move from property to property, just gaining.
Yeah.
Like, I'm gonna sue you for this, and then they leave and they'll try to do the exact same thing.
But especially in public places, offices and retail, you get all these lawsuits all of a sudden. You get contacted by an attorney and says, my client fell on so-and-so space, they, whatever, and they want, and you didn't even know. So it could be lawsuits. What else could it be in the context of development? What else could it be? Gentlemen, we're here, not there.
It's about the, yeah, sorry. It's late. It's late.
You want to share it with the class?
That's kind of like what you're talking about.
Okay. All right. In the context of development, what could be another contingency that's important? What if we have contamination on a site?
ADA upgrades.
What if we have ADA upgrades? Excellent one, right? So all of a sudden, I own an apartment building, and I want to refurbish it, and all of a sudden, by doing certain refurbishments, I got to bring it up to code, and now I've got to like put ramps in and redo the bathrooms and all the access. I buy a piece of land. I start drilling to get samples, and all of a sudden there's like oil there, or some sort of chemical that somebody put, or like dead bodies or whatever. Or, hey, I'll give you a good one. So somebody buys a piece of land in the mouth of the Miami River, and they find an old burial ground. And now they can't build on it. Okay? So, there's all kinds of stuff that can happen, but, there's not that much of contingency other than your land may not be worth anything. But what if it's contaminated, right? What if all of a sudden you've got these wetlands that we had a development site, and what happened? Somebody spotted an eagle. What happens when you spot an eagle on a development site? Can't touch the stuff for like 3 years from the last sighting. Or owls or whatever. So things can happen that are exogenous, right? Should we see if that's for real? No. Okay, they said okay. Okay. So anyway, so those are those things. So we'll go over in detail some of these things. We'll definitely go into development costs. We'll go into revenue recognition. We'll go into leases, and we'll talk about impairment, and we'll talk about consolidations for sure. Okay, we'll talk about taxation a little bit too, just sort of as a primer. So you've got a little bit of but these are areas that you know, either the first ones I gave you are specific or uniquely related to real estate, or ones just because of the nature of business that real estate entities should be concerned with what the accounting guidance is all about, okay? You don't need to know the numbers, but you do need to know that, you know, I'm doing a transaction, right? So I'm a project manager and I'm buying land, I'm buying a brownfield. I know there's contingencies there, I may not know what they are. I gotta call my CFO over, I gotta call the owner over and say, hey, we're doing this, let's get the accountant to see how we're gonna address the reporting of the contingencies that we have. Yes?
Are contingencies always liabilities?
No, that's why they're contingent.
Right, but.
And so, no, so how do you, I mean, you wanna know how to deal with contingencies? So
No, I mean, you've only got negatives.
Generally, commitments and contingencies are dealt with. I hope I'm not giving you the wrong, I mean, I know I'm not giving you the wrong FASB number, so FASB 5 originally dealt with it. I mean, there's obviously been additional. You have an obligation to report contingencies when they are known, probable, and measurable. How do I remember all this junk? Okay? So, if you know that you've got a contingency, if you know that you might be liable for something, you have an obligation, well, and, so if you know you might be liable, if it's probable, okay, and if you can measure it, then you got to account for it, okay? If you can't measure it, but it's known and probable, you got to report it.
So if it's a going concern?
No, going concern is another total issue. So, I know I got a lawsuit, it's probable that I'm going to have to pay $1 million, I got to book $1 million liability. I got to record it on the face of the financial statements. I know I got a whole bunch of lawsuits, but I don't think it's probable that I'm going to have to pay. I just disclosed, under the normal course of business, you know, we're party to several lawsuits. You typically reach out to counsel, you typically get a letter from your counsel, and your counsel gives you the likelihood, his best estimate of whether it's probable or likely, and what the potential award might be. So you say, look, we're party to several lawsuits, we don't believe the company's liable, and hence we haven't made any provisions for that, okay? Or, we know it, and it's probable, but we can't quantify it. We're party to a Superfund lawsuit, you know, the EPA is pursuing legal action, and we're estimating what the impact of that is going to be in the financial statement. So you disclose it in the footnotes, but you can't do a provision for it yet. So depending on the three, you're either just going to disclose it, or you're actually going to record it. So it may be contingent, but to the extent that it's probable, and you can quantify it, you've got to make a provision for it, which you can adjust as time goes on. Did I answer your question?
Well, I was trying to ask if a contingency is always going to be, not in the sense of accounting liable, never mind. Just,
so something that's always contingent doesn't mean that it's going to come true.
no, I get that. What I was saying is it always a liability? Is there never like a positive contingency?
Okay, so yeah, so there might be, so I could be the plaintiff in a lawsuit where I'm trying to recover something.
But do you put that in
And
there?
so,
No.
because we're conservative, we only deal with potential losses and contingencies.
Gotcha.
Any potential revenue contingency, we're going to book when? When we get the cash. When we get the cash. Okay, so that's a good question. I'm glad you brought it up, okay? So we're dealing with potential loss contingencies, not gain contingencies. Hold on. I've got Ryan, and then Nathan, and then Jack.
About the case study, so the contingency, I looked to see, you know, if it was measurable, and then there was the extra costs related to it, and I couldn't measure it in the case.
What was a contingency in the case?
It was 6% on, was it land clearing? On $1,000, projected $1,000 a year.
No, that's a commission.
Oh, broker commission.
No, but that's a commitment. That's not a contingency. I am committed to pay the commission. But when do I pay the commission?
This is
Signed contract.
Well, whenever the service is rendered. You closed. Now, we may have had prepayment, we'll get to all the journal entries, but that contract is a commitment, not a contingency. They're similar, we talk about them in similar contexts, but they're different.
What about retainers?
Retainers are prepayments, we'll talk about that. We'll talk about that in the case study, okay? Nathan?
What's preferable, to know all that information, be able to put it all on, or not to have it all on?
Knowledge is power, right? I mean, there's people that don't want to know certain things, right? The problem that you have, I have a friend of mine does acquisitions and dispositions in for a private equity group. In fact, I'm invested in some of their deals, and so he called me up the other day and he said, look, I got this problem. He says, we're under contract to an institutional buyer to sell this asset. Now, he's asking me, I want him to sell the damn thing. I told you I'm a seller. I'm like, but he says, look, one of our tenants is a hardware store. I mean, it's a hardware store. It's been in this industrial complex for 30-something years. So they bought it. These guys were there. They're doing retail business. Now, they've got some wholesale accounts, but it's a retail hardware store, and it's an industrial zone place. And so apparently, as part of the due diligence, people started, calling and asking, and all of a sudden, out of the blue, an inspector showed up. And an inspector said, "Wait a minute, there's retail going on here." And he went and knocked on the door and said, "Hey, what's going on here?" So the people got very, no, we don't really do retail sales here. And then they apparently started, the owner of the business came to the landlord and said, "Look, we got an opinion in 1978 when we moved in here that said if X percentage of our sales were wholesale, we could be an industrial zone," some sort of. And so the question was, my friend says, "I know that there's a potential use problem here. Do I disclose this to the buyer or not?" Now, that's not a financial reporting issue, but that's a moral issue. And I said, "Look, you got to tell them. You got to tell them. You can't close. What you can't do is close, and 2 weeks later, all of a sudden the tenant gets a notice that says, 'Hey, you've got a use violation here.' And this guy's going to blow up his business or leave because he can't do his business there." And it was a pretty sizable tenant. Now, what do you do at the end? They notified the buyer. Buyer's aware. Nothing's happened yet, but buyer was like, "Okay, we're good with this." But so, do you want to know? I think you always want to know. But if you know, then you've got obligations. Whether it's financial reporting or otherwise in the industry, you've got obligations. If you know, you got to tell them. Yeah? We'll go into the case study now. I was going to say that the only thing I had in my notes that I wanted to talk to is another area we'll talk about as the class goes on is REITs. We've talked about it a lot. The only thing I want to say is REITs. REIT is an election under the tax code. So it's section 856 of the tax code. It's an election. So it's not a company structure. So it's not an LLC or an LLP. It's whatever entity. It's likely a C Corp, but it elects to be treated under section 856 of the tax code. And the reason that was created was to eliminate double taxation, and it was to do a couple of things. One was to increase investment in real estate, long-term investment in real estate, and to give individual investors access to passive income so that they could be in a tax-advantaged environment, in a tax-advantaged environment in real estate, okay, and to provide some liquidity for individual investors that wanted to invest in real estate. Because liquidity is difficult in real estate. Real estate is a long life asset. From an equity perspective, there's significantly more private equity than public equity. But the problem is, if it's private equity, it doesn't have liquidity. And individual investors need liquidity. Institutional investors may not need it. They've got a much longer term horizon. They don't have the needs for liquidity. they may even have access to liquidity that individuals don't have. So it really was just sort of a creation. They've had, you know, they had a boom. Well, they went crazy in the 60s. They kind of blew up in the 70s, and it's kind of picked up from the 90s on and become really a mainstay of institutionally owned real estate in this country. And for us, the good news is there's a lot of financial reporting, and it gives us great insight into what's happening in different asset classes and in the markets, okay? I'm not going to spend any time talking about construction company accounting, but it does have long-term implications, all right? So you enter contracts sometimes that are, you know, 3 years long, and so, you know, I've got to recognize revenue, I've got to recognize profit, but I'm not there, so the use of estimates is critical there. The accumulation of information is critical there. The structure of contracts is critical there, okay? Cash flow, well, yeah, that's in any business, really. So, you know, the notes I had here from a textbook I used to use here, which I thought, you know, real estate cuts through all businesses. That's a kind of curious thing. So we're looking at real estate from the perspective of development, but real estate in a lot of businesses, you know, especially in an area like South Florida, with so many foreign people, real estate is an integral part of the wealth of a family. And a lot of people tie their personal wealth to real estate and tie it to the company. And so, you know, how do you deal with that? From a scale perspective, 10 to 15% of GDP, 9 million jobs. So it's, you know, it's an industry that cuts throughout. But what's interesting is it has long cycles. And so that's good and bad. So it allows us to hold the asset for a while, but it creates a tremendous amount of uncertainty. So we don't know what the market is going to look like when we deliver, right? And so we think everything's great, we start a process, but what's the market going to look like in 3 years when we're delivering? And so, because we don't know the time horizons there, and because we have assets that take long periods of time, there are unique things related to accounting and financial reporting, as you'll see, that are important for us to keep an eye on. So with that, what I'm going to do is I'm going to jump to the case study. And very, very basic. I kind of made this up one day. I say made this up over a series of days. They asked me to teach this accounting class, but you know, they gave me these like heavy duty. They said, you know, use these texts, and one was a book written by a lady named Maria Davis, who's a partner at Deloitte. It was an accounting manual. And then I had a book from a guy named Klink that was a guy I used to work with that was a predecessor to her. And, you know, really heavy duty. I said, let's put some of this stuff into practical matter. So I was on a cruise with my parents off the coast of Brazil. That's why you hear things like Janeiro and Paraty and Santos and all that kind of stuff, you know. But what I tried to do was just create a series of simple transactions that would give you or highlight a sense as to why, or ultimately what accrual accounting is all about. So I have situations in here in which services were rendered, but they weren't paid for. I have situations where money was paid, but services weren't rendered. I've got situations where money was collected, but we didn't render services, right? And so I've got all these different things that just try to point in a very primary basis how accounting would deal with all these transactions. And so, you know, you stop to think, you know, this guy, Recife, paid $1,000. Well, you know, nobody puts a $1,000 deposit on a big, you know, chunk of, you know, land, but you're going to have to put money, you're going to put money in escrow, and may go hard at a certain point. How do we account for that? What if our month end, or our quarter end, or our year end is at a point where we receive some money in escrow? How do we account for that? How do we report it, right? Do we record a sale? I got a sales contract with a guy, he gave me money. How do I do it? Yes, Jeff?
How do you record it, or why would you record it if it's in an escrow account? You didn't receive anything.
But I'm a party to a contract, right?
Okay.
Right, and I'll show you how I recorded it, and then you can see there may be other ways to record it. So, I mean, I can tell you, I don't think it would be appropriate to not record something. So, you're a party to a contract on which funds have gone into escrow and you don't physically have it, but you've got a potential right to that.
Yeah.
And I think, while I think if it's not material to your overall balance sheet, maybe you look the other way. I think the appropriate treatment is to give it a recording, and we'll go through that. Yes, Brian?
Would that money eventually be contingent on the actual sale of property? Because along the
Right,
way-
so is it a sale or is it not a sale?
Is it a contingency?
Not yet, but is it a customer deposit maybe? Maybe,
That's why you receive on contingencies of,
but I received it.
okay.
It's like a gift card if you lose.
Well, well, hopefully, hopefully it's a little more than, you know.
It's the principal.
Yeah, so.